This Thursday, November 7th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get to the three things that you need to know today.
Good morning, everyone. First up, U.S. stocks holding their post-election gains, hovering near record highs. Traders continue to digest what a Trump presidency and a potential red sweep of Congress would mean for the economy and the Federal Reserve's interest rate path. The central bank is poised to cut rates by 25 basis points today at its meeting, but Fed Chair Jay Powell faces new questions on what a second Trump term means for inflation and market volatility amid proposed fiscal and tariff policies.
Plus, Lyft shares surging today after the company topped Wall Street's expectations and raised its outlook for the full year. The results showing that signs that the ride-hailing company is succeeding in its plans to attract more commuters. Lyft also announced plans to bring autonomous vehicles to its ride-sharing platform in 2025 through partnerships with self-driving technology firms Mobileye and May Mobility.
And a mixed bag for chip earnings. Qualcomm shares, they are soaring after the company topped estimates amid a pickup in smartphone demand. But shares of chip design firm Armour, they are falling after the company offered a disappointing revenue forecast with smartphone weakness outweighing expectations for AI-fueled growth. Both of the company's earnings pointing to a pickup in demand for high-end smartphones, but falling short of showing that the industry is on solid ground. U.S. stocks holding on to post-election gains this morning. You can see futures there green across the screen right now as investors remain optimistic about the market ahead of the Fed today. And as the Fed is, of course, going to take kind of center focus for the markets in an action-packed week with earnings, of course, the election, which was really taking center stage, and then now the Fed here. Let's think about what all of this means and continues to mean right now, especially coming off of some of the post-election gains that saw record highs get notched yesterday here. I mean, the Trump presidency is essentially going to be taking office at a time where we've already, in a year where we've come off of consecutive record highs in the stock market. You've also got a Fed that's beginning and has begun its easing cycle and is firmly on that path until we hear otherwise in their tone. And at the same time, you've got Moody's saying that after this November meeting, we're looking at a potential no cuts post-November scenario. Larger question, what that means for the expectations around how quickly the market will start to digest what a wait-and-see type of approach might mean for the Fed. But as of right now, continuing to see some very solid gains right now and broad-based within the markets.
Yeah, certainly. It's been interesting to see maybe a bit of a reversal, at least from yesterday's outperformers. We're seeing some shift. Financials, obviously, the outlier there. We're still looking at gains here ahead of the open, but really earnings coming into focus. Of course, the Fed, a little bit of a recalibration going on Wall Street, just in terms of the Fed expectations, in terms of rate cuts and what exactly that is going to look like over the course of not only the next two meetings when it comes to the decision today and also the decision that we're going to get in December, but also just looking out to 2025. We have certainly started to see Wall Street, some of the larger banks, scaling back on their expectations. Of course, as we get commentary from Fed Chair Jay Powell today, he will give us a better idea of exactly what that's going to look like going forward. But again, the exuberance playing out in the market and the number of strategists, Brad, that you and I talked to yesterday on the heels of of Trump's victory here for the White House. I think there was some caution just in terms of whether or not the market was getting a little bit too ahead of itself and whether or not there was still some questions just about policy, what exactly Trump is going to be able, President-elect Trump is going to be able to get through Congress, given the fact that we still don't have an answer on control of the House. That is very critical as you get a little bit more granular just in terms of what these policies ultimately mean here for Wall Street. But again, you are still looking at a lot of optimism here this morning as we do have this move higher. But I think the next few days are going to give us maybe a more accurate look at what 2025 and beyond could potentially look like here for the market.
Yeah, balance of power firmly in focus here as well. The Federal Reserve is largely expected to cut rates by 25 basis points at its meeting today. Yahoo Finance's Fed correspondent Jennifer Schonberger has more. Hey, Jen.
Hey, Brad, good morning. That's right. The Fed widely expected to cut its benchmark interest rate by 25 basis points this afternoon. But Fed officials expected to keep their head down and avoid any surprises just 2 days after the U.S. presidential election. Though behind closed doors, there could be divisions over what to do today and the course forward for monetary policy. Fed officials have to make sense of a mixed bag of economic data that show a strong economy, persistent inflation, and a muddled jobs market that's been disrupted by weather and worker strikes. There could be a debate between those who want to cut today, those who could support a pause, or those who would support a cut with communicating a more gradual approach to cutting rates. Fed watchers expect Fed Chair Jay Powell to forge a consensus around a small cut following a jumbo-sized 50 basis point rate cut in September. Powell will face questions at a press conference about the election outcome and what it could mean for the economy, inflation, and setting interest rates. Officials are unlikely to change their policy approach until they can see what President-elect Donald Trump does with proposed changes to taxes, tariffs, and immigration. Of course, a lot hinges on whether the House actually flips Democratic or whether there is a Republican sweep, which is looking more likely because that will dictate whether Trump's proposed policies could get implemented in full or not. This decision coming down at 2 p.m. Eastern, followed by Fed Chair Powell's press conference at 2:30. Back to you.
Yeah, Jennifer, as you talk about Powell's press conference here later on this afternoon, what do you think are going to be some of the key things to listen for here as we try to game out maybe what the next several months are going to look like?
Yeah, Shauna, I think we're going to be left, unfortunately, with more question marks than answers. I don't think that the Fed chair is going to answer any questions about what the president-elect's policies could mean for the economy going forward. There's just too much uncertainty. But three specific things I'll be looking for are any signals around whether the Fed could cut rates again in December, how he's looking at a possible scenario there. Number two, how is the Fed looking at inflation right now? Based on their preferred inflation gauge, inflation has been stuck at 2.7% for 3 months. So are they still confident that inflation is going to continue to fall towards their 2% goal in a timely fashion? And then number three, as you know, the economy has continued to surprise to the upside, 2.8% GDP growth in the third quarter, buoyed by consumer spending that grew at 3.7%. So does he continue to see this economic growth surprise to the upside? And if so, what does that mean for the pace of cuts going forward?
All right, Jen, thanks so much for taking the time to break that down for us. Of course, we're looking ahead to what exactly we hear from Powell in just a few hours from now. Well, the sell-off in the bond market is cooling today as investors shift from the election to the Fed ahead of the rate decision later on this afternoon. Joining us now, we want to bring in Janet Rilling, Allspring Global Investments Head of Plus Fixed Income Senior Portfolio Manager. It's great to have you here, Janet. Let's talk about maybe what the bond market is telling us versus what maybe the more realistic expectations are at this point. How are you approaching what we'll likely hear from Powell and how you see the next several months playing out?
Yeah, I mean, with the election somewhat behind us, we have more information, which is helpful. I think the Fed is going to digest that, but they're not going to extrapolate too far because we still need to learn what's going to happen in the House. Further, there's a lot of uncertainty still in the economic data. The growth picture has been positive, and I think that, looking forward and thinking about the economy continuing to expand is a good base case. But the Fed certainly wants to move their rate off of what they view now as restrictive. So they're, all else equal, they want to cut rates. The expectation today is 25. I think likely in December 25. But from there, they are definitely data dependent, and they may have to adjust their view on the terminal rate, given what we're seeing in the economic data.
Where do you think that may move the terminal rate to? And the dot plot right now, I think we're sitting at somewhere between 3.25, 3.5 as what they're thinking as of this juncture.
Yeah, I think above that, maybe we've got another 100 basis points of rate cuts if the trajectory continues with the growth picture. Employment is key here. We've had a noisy job report, so getting another one without the strikes and the hurricanes, I think, will be quite helpful to give them more information. And then, of course, probably the most important metric, inflation. And the election does add a little bit of risk on the inflation side.
Typically, the Fed would need to cut rates in order to spur demand. It seems like what we've continued to hear is a resilient labor economy, and then additionally a resilient consumer as well. And of course, it's we can't just paint the consumer with a broad brush. There are areas where there is severe deterioration, especially in the low-end cohort. But all of these things considered, what do you think that means for the type of further pullback or type of further deterioration that the Fed would need to see at least within their dual mandate in employment, maximum employment, and inflation, and tempering that and stable prices in order for them to get to some of the eventual terminal rate that they're looking for?
Yeah, I always step back and think about this cycle as being unusual. The Fed is not cutting because we are going into a recession. They're not cutting because there's some sort of crisis. What they are doing is moving off of restrictive level of rates. And so it feels unusual because that's happening at a time that we see growth and, to your point, strength in the consumer. So I do think that is their general guiding principle. They don't want to be in the position that they're tipping the economy into recession. So their goal is to get off of that restrictive level. But the crosswinds and the thing they have to really balance is if the economy is accelerating, are they adding fuel to potential price increases down the road?
Have your forecasts or expectations for inflation changed?
Our view has been that it's moving in the right direction, but to get kind of that last mile to the Fed's target is going to be pretty difficult. Things are sticky. The inflation picture is sticky at this point.
I guess how much more complicated do you see that now being once Trump is in the White House?
I think it does increase the risk of inflation not getting to target or potentially reaccelerating. It's not our base case, but it is an area where I think there is a bit more risk for the bond market.
To what extent do tariffs play into that projection as well here?
They certainly play into it. If we get the case where they're very broad and high levels, particularly the tariffs on China, that will move into the real economy. We'll see upward pressure on input costs for manufacturers. Many of the retailers source their goods, so that's going to either impact margins or they're going to have to raise prices, and then that moves into our economy. The other piece is the wage side. If we can see some moderation in wages, and there's been some evidence of that, perhaps that could offset it. But the good side, I think, could be the place we might see some potential pressure.
Janet, thanks so much for taking the time here with us this morning.
Thank you.
Really appreciate it. Janet Rilling of Allspring, thank you. Much more ahead on Morning Brief. Stay tuned. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. We've got Yahoo Finance's trending tickers page that'll send you to. First up, let's talk Qualcomm, extending gains in the pre-market after beating fourth quarter expectations. The chip maker also issuing a strong outlook for the current quarter The company's board approved a more than $15 billion additional stock buyback after it repurchased more than $1 billion worth of shares in the fourth quarter. Joining us now, let's bring in Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst. Patrick, always a pleasure to get some of your insights here. You know, for those that were listening in on the call and trying to gauge where some of the buybacks versus where the acquisition talks have also moved forward here, you know, what is the net takeaway that investors that are trying to understand and parse through the details and figure out whether or not they should be adding into or creating a position in Qualcomm should be creating as the central thesis or the theme around the name right now?
Yeah, the number one thing to be looking at, what investors should be paying attention to, is its ability to diversify. I mean, 5 years ago, Qualcomm only stood for smartphones. And while smartphones are a very large percentage of their revenues, they've diversified into a gigantic automotive business with a $45 billion backlog. And as we saw the last quarter, IoT, particularly the industrial IoT, is starting to get a play here as well. Obviously, you know, the conversation about China and any potential ramifications from any changes in U.S. policy on that, but that has always been a specter for the past 5 years. And even when Trump was in 2016 for a first term, but nothing came out of that. And I don't expect anything to come out of that this time.
So Patrick, talk to me a little bit more about that. I guess just in terms of the landscape under a Trump administration, M&A, lots to talk about potentially Intel, but other deals within the space. How do you see that evolving now with a change in the White House?
So as we saw in 2016, Trump came out and made a lot of proclamations about tariffs, about taxation. And what ended up happening was a lot of nothing. It's more of I believe it's more of a negotiation tactic that's used to get greater investment here in the United States. Something that people don't talk about enough is that the groundwork for the CHIPS Act actually started under the Trump administration. I was actually interviewed for a lot of the data that went into that. And I know there's a lot of talk about clawing that money back, but I believe it's just a negotiation to get TSMC and Samsung to be investing more here in the United States beyond what is in the CHIPS Act.
I mean, wouldn't that further concentrate some of the fabrication under external or foreign entities that, yes, may have their own factories here in the U.S. that they've been incentivized to kind of build up and make sure that they could service some of their customers here? But what does that mean for the America First pitch that was campaigned on?
Yeah, so I don't know yet if the current administration cares who are making those investments, Intel, Samsung, or TSMC, or even Global Foundries. But I think we will find out very quickly. I do think that this is a good sign for Intel. Intel obviously is not only an American company, but they are rapidly investing in a foundry business, tens of billions of dollars just invested in Columbus, Ohio alone. And I think Intel will likely be the winner as long as it can deliver on the technology that it's promised. And so far, in a node called 18A, things do look positive, but I don't think the numbers work yet for Intel because they need to get a very large external customer to be able to fill in that capacity and pay for that investment.
But Patrick, what about M&A specifically? What do you think that looks like then for the tech sector?
So I think M&A looks a lot better. I don't see Lena Khan and staff hanging out very long. And I do think we're going to see a lot of opportunity for M&A. I think it's going to heat up. And, you know, there's two ways to look at that. I think the upcoming administration looks at it first as a national security risk, meaning if our companies are getting broken up and unable to do M&A, what does that mean for the United States versus China? I think for even the VC market, right, there was even a question on the saleability of these upcoming startups. And I think as those loosen up, we're going to see a lot more M&A activity. One thing to keep in mind, though, it's not just U.S. policy when it comes to M&A. It's getting these approved in other districts out there, like China, like the EU, like the UK and Korea. Any major acquisition would need to be approved by those agencies as well.
Do you think that it is company to company type of acquisitions or M&A or capital infusion? And maybe that's the better way to think about it, because if we think about capital infusion, then it's also thinking about the fact that you could see other nations or other entities outside of the U.S. investing in some of these companies that have a critical kind of pillar status for either the advancement of chips or the advancement of artificial intelligence, whatever piece of technology you want to pick. Is that company to company specific or nation to company?
I think it's both, and particularly nation to company. There is a lot of money flowing in the Middle East, in Qatar and in Saudi Arabia. They're investing tens and hundreds of billions of dollars internally to make that happen. But you could potentially see more of those dollars flowing in. I do believe that overall we will see an uptick in equity values given this administration and what they're going to do. They certainly don't want to be viewed as the administration that brought the tech rally down in particular. And I do think they will enable a lot of country to U.S. And I think a lot of countries want to invest more into the United States to be able to ride what I believe is going to be the next wave in tech stocks.
All right, Patrick Moorhead, always great to get your insight, more insights, and strategy founder, CEO, and chief analyst. Thanks so much, Patrick.
Thank you.
Another trending ticker that we're watching is Moderna, posting a surprise third quarter profit boosted by cost cuts and also higher than expected sales of its COVID vaccine. We want to bring in Michael Yee. He's Jefferies biotech analyst. Michael, it's great to have you on. Just give us your first initial reaction to these results. Clearly, the street pretty excited about what they saw just in terms of the initial uptake of the COVID vaccine this time around. How does this then play in to your models and your calculations?
It's great to be here. Good morning. I think I would say first that while there was a headline beat in part due to hundreds of millions of dollars of higher sales reported for the COVID vaccine, they maintained the guidance. So it was mostly, in our opinion, due to timing of the shipments and the orders, because actually all the COVID data and jabs and vaccination data is available for third party. And so there's not a big surprise in terms of the vaccination uptake, which actually is, in our opinion, tracking about 10 to 15% lower year over year, which shouldn't be a big surprise to people.
You know, as I'm taking a look at some of the performance year to date for S&P 500 companies, Moderna is within the top 5 of the worst performing companies over the course of this year. Is there anything within these earnings or that you hear from the company right now that signal 2025 will be different?
Well, the answer is no. I expect that next year will also continue to be a fairly challenging year, certainly with respect to opportunities in the broader market or other biotechs, obesity stocks, or other growth stories. And that's because obviously the market believes that vaccination rates and the overall business next year will be challenging, and certainly they continue to burn a lot of money. So actually the company does have guidance for next year, just to be clear, which is revenues to be a bit down year over year. And so it's much a bit of the same next year.
Talk to us a little bit more about what comes in terms of contract negotiations in the spring of 2025. Lots of questions about what exactly that is going to look like, whether or not that's an overhang or could potentially be a catalyst here from the stock. What's your read on that?
Well, look, I think for next year, if you're talking about spring contracting for COVID and also for RSV, it's still mostly a two-player race in COVID. One of the things we fear a little bit is that while the vaccination rates, so volume, is probably going to be flattish or down again a bit, we're concerned a little bit about price. Actually, the price took a big cut in 2024 as Pfizer, the other player, and even Novavax to some extent are being competitive. So price is not going up. I'm sure you could appreciate it's going down. RSV, you could appreciate, is still going to be a bit of a challenging period again next year as well. The RSV numbers for jabs are down 40 to 50% year over year. And the ACIP guideline committee, which is in charge of recommending things, has not recommended a second shot after 3 years. And so that while this was expected to be an annual boost, it's now looking like a once every 4-year boost, which is not good. So the bottom line is 2025 is a bit about much ado about the same. And therefore, that's a concern.
Michael, just lastly, while we have you here, I mean, it seemed that during the pandemic and in the aftermath of the pandemic, that everybody and their mother became a self-proclaimed expert on messenger RNA technology. And we heard in the thesis from investors that this was going to be applicable to so many other diseases, viruses, and that Moderna could be one of the core names within that. Is it evident where the next element of the broader rollout of messenger RNA to other solutions is right now from the company?
Well, look, on one hand, there's no doubt that mRNA technology definitely works broadly across multiple respiratory vaccines. To give them credit, they have an RSV vaccine that's approved. Let's give them credit for that. There also may be, and we're on record on this, maybe a positive phase 3 CMV vaccine announcement soon, which is another vaccine for respiratory virus, CMV, particularly targeted to women who seek to have a baby to protect the baby. Obviously, the Merck cancer vaccine as well is partnered, and there does seem to be promising data there, but it's going to take a few more years to see that play out. So while there is broad applicability, this is an issue of the timing of when these things came out, and particularly a very competitive vaccination market.
Right.
That's the problem here. And the high burn causes them to burn a lot of cash, which in this market, guys, right, is a problem. Yes.
All right, Michael Yee, great to have you here. Jefferies, the biotech analyst, thanks so much for taking the time to join us here this morning. Coming up, it's the opening bell on Wall Street. Stay tuned. You're watching Morning Brief. There's the opening bell on Wall Street. Let's do a quick check of the markets coming off a very strong day here for the market. You are, though, looking at gains here at the open as the major averages trading gets underway for the major averages. You got the Dow just above the flat line here. The S&P here, as we calibrate, opening up just above 5,900. Again, close trades to keep an eye on. NASDAQ is still, we're waiting for that to open. Let's take a look at the bond market here. A bit of a give back here. You've got yields off just about 4 basis points back below that 404 level. Taking a look at Bitcoin, we saw a massive surge, a massive uptick in Bitcoin yesterday, once again moving to the upside again today, really close to that 75,000 level. Taking a look at the sector action, a bit of a reversal, maybe a give back of yesterday's initial gains for some. Actually, at the open, we're not seeing too much of that. You had financials, the outperformer yesterday, opening the day off just about 0.4%. Still early, though. And of course, when you take a look at the street's reaction, very bullish on the sector here under a Trump presidency. Technology leading the way today. You also got healthcare. That movement to the upside here, much of that driven by earnings that we're getting out this morning. You also have utilities and communication services among the biggest gainers there. Look inside the Dow, some of the Dow components there, how things are shaking out in early trading. Large cap tech, among the outperformance here, you have Apple up just around 1.3%. You're also seeing slight gains in Amazon and Microsoft. On the flip side, you're looking at some of the financial plays under pressure. You got JP Morgan off just about 1%. Jared Blickery standing by with a closer look at these moves. Jared.
Thank you, Shauna. I can't underscore what a bullish day yesterday was. And when you break it down, it's not unusual to have a little bit of a give back today. And we're not even seeing that. The S&P 500, I'm going to put a 4-day on here, adding to the week's gains. It is up almost 4%. And by the way, the S&P 500 had its best post-election day yesterday ever. And so that's something to perhaps write home about. And then the Russell 2000 had its best day in about 2 years. That is another November breakout story from 2022, but that is up 8% and finally back up to almost to the record highs that we saw 3 years ago. That's a 3-year chart. Here's a 5-year chart, so it is right up testing some of that price memory up in there. We'll see. It could take a little bit of a few more months even to break out as this pattern completes, but that's something that we'll be watching for. One thing that's already happened, we have seen the Dow transports. Those broke to a record high, the first one in 3 years. Doesn't look like I have a chart for that right here, but I did want to mention that. And then here's the 10-year T-note yield. That is giving back some of the gains that we got yesterday, but this is such a big move that this could be a problem for equities. We're going to have to see what happens with the Fed today. The Fed is big in the bond market, and kind of mind-blowing that we do have a Fed day after this huge catalyst of an election that we just had, but that is what we are dealing with. And then here's the sector action. Tech is leading, financials are lagging, but that's after financials had the best day in several years yesterday. And I wanted to take a quick look at the Magnificent Seven because we even have the MAGS ETF, that's MAGS. That just hit a record high yesterday and another one today. And finally, futures. We are seeing a little bit of an uptick in not only copper, but also silver, also gold, and that is after a pretty big drubbing that they took yesterday. Guys?
All right, Jared Blickery, thanks so much. Appreciate it. With the kickoff for the trading session there. U.S. stocks trading at all-time highs as they hold post-election gains. But how will Trump's policies impact the market going forward? Joining us now, we've got Gina Martin-Adams, Bloomberg Intelligence Chief Equity Strategist and Global Director of Equity Strategy. Gina, good to have you here with us today. So first and foremost, as you think about going forward from here and from this point, there's an inheritance of a market that's already at all-time highs. Where are the policies that are campaigned on expected to take hold among corporates that are some of the most heavily favored within the market right now?
Yeah, I mean, I think it's first pretty important to recognize seasonality, particularly seasonality following an election cycle. We did very typically have a weak October. We very typically have a weak October in advance of U.S. elections, followed by a significant bounce in November and December. So we should anticipate that seasonality will favor stocks. It's not atypical for stocks to experience a bounce with a post-election kind of relief rally. So that's first and foremost. Secondly, I think you need to consider where we are in the economic cycle and where we are in the yield curve cycle and where we are as well with respect to the earnings cycle. Very importantly, these are strong long-term drivers of stocks. The yield curve is becoming much more upward sloping. That's certainly driving some preference for financials. Financials also had a fantastic third quarter earnings season to follow up on what was a very solid second quarter earnings season as well. That's creating some optimism on financials, irrespective of the election, the election results and the potential for regulatory easing to benefit that sector as well. I think it's also important to consider what's going on broadly in the macro. And we're coming off of a point of very weak macroeconomic conditions. It's been a choppy recovery from the earnings recession that the S&P 500 experienced in 2022 and 2023. But we're starting to see that earnings sort of broadening occur. We started to see this up to 6 months ago. It's continuing in the near term, and that's allowing for better performance, better distribution of performance across the market. So as much as the election is certainly playing into market conditions in the short term, there are a lot of other underlying factors that I think are really important to consider. One of the big things, though, that we did see yesterday that was very different than the 2016 election response in markets was healthcare. In the 2016 post-election rally, the two sectors that performed best were financials and healthcare. That was not the case yesterday. What we saw was financials and industrials instead as strong performers. Healthcare was a very big laggard. This, I think, is the sector to watch going forward. It's one of the bigger sectors in the S&P 500. It doesn't get talked about a lot, but there is a lot of potential fear of a rebalance in the healthcare spending priorities with this administration. Will we see a rollback of Obamacare? Will we see a lot of movement in healthcare? This is something that nobody's talking about, but yet really stood out for us in the data yesterday.
Are you scaling back your exposure to healthcare based on that?
We don't make recommendations on sector exposures. We simply relative rank sectors and do a sector rotation model. And certainly it's very speculative right now to try to suggest where we think this administration is headed with healthcare. Healthcare does tend to screen well. And I think most investors are looking at healthcare as an opportunity right now because valuations are relatively suppressed. Earnings are in a cyclical growth sort of state. We're starting to see better price and performance, or at least we were prior to the last couple of months, but that could get squashed by the administration's policies. So I think you want to be on guard for it. We very rarely sort of try to preempt, but instead tend to follow along with policies and start to imply probabilities as those policies are likely to be enacted or not. It's too early yet, but I definitely think it's something to watch for over the next 3 to 6 months.
Gina, I'm curious from the models and what you're seeing just in terms of inflationary pressures right now. Clearly, that's a concern for the street of exactly what that is going to look like under Trump. We had a guest on earlier this morning talking about that as well. What do you think? How do you think the Fed is thinking about that and how that's going to play into the calculus here?
Yeah, I think the Fed's not thinking about any sort of inflationary pressures as worrisome right now. It's far too early to anticipate that. What we're seeing now in the inflation data has generally been decelerating pressures, with the exception of the labor cost report as of this morning. We generally see pretty decelerating inflation pressures. This disinflationary trend has been very supportive of overall margin conditions for the S&P 500. With respect to this administration and the election results yesterday, inflation is definitely on our radar as something to watch for coming into 2025 and into 2026. But for now, I don't think inflation is going to get in the way of the Fed. What would get in the way of the Fed is the dramatic improvement in financial conditions. I don't think, again, this is going to get in the way for this meeting this week, but come December and into the first quarter meetings, if financial conditions continue to improve at such a robust pace, that could be something that triggers a shift in Fed policy, particularly if economic conditions are continuing to improve. We can't ignore the fact that even though the employment reports have been a little bit dicey over the last couple of months, broadly, economic reports have been beating expectations pretty persistently. So as long as growth is relatively stable and inflation is contained, the Fed has, a pretty clear green light. But if growth starts to accelerate and inflation pressures start to accelerate into 2025, that's a very different story, particularly if financial conditions are improving so robustly.
All right, Gina Martin-Adams, Bloomberg Intelligence Chief Equity Strategist. Thanks so much. Well, sticking with tariffs, Trump's potential 10% tariff on all imports and 60% on Chinese imports could hit discount retailers and footwear makers particularly hard. That's according to analysts. Our very own Brooke DePalma has been sifting through those notes. And Brooke, what does the street say?
Yeah, right now, these discount retailers like Dollar Tree, Dollar General, Five Below, seeing a bit of a gain this morning after seeing losses on Wednesday following the announcement of President Trump taking the office once again. And investors really spooked that these companies are going to be disproportionately affected by the potential tariffs that Trump is expected to take because of the amount of products that they ship from China. Now, Five Below has multiple price points, but Dollar Tree and Dollar General, well, they're really sticking to that $1, $1.25, but others warning that if Five Below did raise prices, well, then that could cause consumers to go elsewhere. And it would take a while for Five Below to diversify their supply chain as they've been doing in recent years since really 2019 when we saw Trump's first trade war. And footwear, another big industry to watch as a result of these potential tariffs. That was a big conversation in 2019 as China's cheaper manufacturing costs means mass retailers can produce these sneakers at a lower cost. Now, Matt Priest, he's the CEO of the Footwear Distributors and Retailers of America, and he said prior to Trump's first presidency, these sneaker companies have been diversifying their portfolio, but back in 2019, that really poured an accelerant, he called, for these companies to really diversify. And that's what we've been hearing. Skechers, Brooks Running, working their way around and looking to other places to produce and source their inventory from. But Skechers CFO did tell Yahoo Finance back in September that should this be the case scenario, they might have to increase prices to offset margins and continue to be able to innovate. A similar story from Brooks Running. They said that additional 2025 tariff is huge and also takes away from their research and development. Now, it's a matter of when and if this happens. And of course, we know that Trump did, in fact, vow to lower prices, and inflation is a top concern. So will prices increase? And also, with inflation top of mind for Americans, how much would this happen?
You mentioned Dollar General, and a company that also reported earnings just partnered with them, and that's e.l.f. Eyes, lips, and face. And the company's moving higher off of those earnings by about 9% last I checked.
Yeah, Dollar General, big partner for e.l.f. Beauty as customers and consumers really seek value here. Those dupes, those lip oils, those Dior lip oils that e.l.f. Beauty has been able to dupify, I guess you could say.
It's real to me, bro.
But e.l.f. Beauty raising their annual guidance when it comes to net sales to the range of $1.32 billion to $1.34 billion. That's above their prior forecast. And it's not just Dollar General where now e.l.f. Beauty customers will be able to shop. We also know that e.l.f. Beauty is available at Walmart. They're available at Target. They're also available on Amazon. And so really they've been able to lean into this environment where consumers are very choiceful, but also now at Dollar General, gaining that lower income audience as well.
All right, I get my beauty supplies from Target, so maybe I'll see the e.l.f. Aisle over from the can too. Appreciate it, Brooke. Thanks so much. Staying in the retail space, shares of Under Armour, they are pushing higher as the company's turnaround plans gain some steam here. The athletic brand is now expecting its operating loss for the fiscal year to be as much as $196 million. That's compared to the previous forecast for a loss as deep as $240 million here. Shares, they're jumping higher right now by about 24%. Of course, Under Armour, the brand that houses the Curry brand, Steph Curry fame, of course. And then additionally, just thinking around what this turnaround plan needs to see for investors. Number one, you got to come back to exactly the assortment and the mix that they're putting out there and what that innovation looks like. That's what we hear about from so many of the analysts who cover this space. What is the newness actually going to look like from brands like Under Armour, from Lululemon, who feels like they just continue to put new colors on everything, sometimes the same colors, and then additionally from a Nike as well. And so for Under Armour, Nike, Lululemon, who are seeing even more of the competition from brands that are just able to do really well on social, market themselves, and then create community. Community is the new thing that we're going to hear about from all these companies, and be interesting to see how Under Armour is thinking about creating community to drive product sales at the end of the day and lessen some of the input costs at the same time.
Yeah, and I also think there's a lot of questions on the street just what exactly the company itself is going to look like under Plank. Yes, these results do show progress in the right direction, right? But they also still need to return to growth. When you take a look at these numbers, you're a far cry from where maybe the levels ideally, obviously, would be here. So yes, they are showing progress, but more is going to be needed. We're seeing the streets excitement here this morning. But as you talk about future gains and what exactly it is going to look like, how Under Armour is going to compete with the bigger names within the space. I mean, you stack up Under Armour versus Nike, clearly a massive gap just in terms of performance and what they're seeing demand-wise, what they have in their pipeline. So still a ways to go. But again, the street at least encouraged by some of the changes that have been made under Plank since he did return earlier this year.
Yeah, it's got a lot of ground to gain back here. I mean, of course, even as we're looking at some of the year-to-date highs, 52-week highs that the company is notching here today. Also, everyone, coming up, transportation company RXO. They're out with third quarter results before the bell. Those dropped. We'll discuss the quarter and the potential impact of Trump's imposed tariffs with the CEO next.
Freight and transportation brokers provider RXO reporting third quarter results before the bell today, the company's first since completing its acquisition of Coyote Logistics. Adjusted EPS for the period coming in line with expectations. Revenue just slightly below what the street had been looking for. The company is hit by a 7% year-over-year decline in managed transportation revenue. Here to discuss the quarter and what freight demand looks like going forward, we want to bring in Drew Wilkerson. He's the CEO of RXO. Drew, it's great to have you here. So talk to us just as we do take a step back, what your results tell us, the guidance here, what that tells us more about the macro picture right now of the supply chain and logistics sector, and what you're seeing as we head into the very important holiday season.
Yeah, so as far as the quarter played out in the third quarter, there's really three major takeaways. First, we completed a transformative acquisition of Coyote Logistics, which we acquired from UPS. That will more than double our overall size of our truckload brokerage. When you look at where we are right now in the process, it's been our business for about 6 weeks, and we are well ahead of schedule of where we thought we'd be from an integration standpoint. That includes conversations with customers about growth, retaining them, employees, retaining the right employees, and the technology integration. The second thing that I highlight on the quarter is we hit the expectations that we laid out from an EBITDA perspective for the street. So, even though we are in a down freight market, we've been in a freight recession for well over 2 years, we're still hitting the expectations that we highlighted. And then the last piece is our complementary services performed extremely well. In last mile, we grew stops by 11%. Our managed transportation pipeline is well over $1 billion. And we're going to onboard $400 million of freight under management in the fourth quarter. So there's a lot of progress that's happening within the business. Your next question was what's going on in the overall macro and what can we expect for the fourth quarter? Right now, our customers are telling us to expect a muted peak season, which would be similar to what it is what it was from last year. As you move into next year, obviously under a Trump administration, it'll be interesting to see how things play out with the tariffs, because that could cause an increase in demand as we go into 2025 in the truckload market.
Okay, so as you game out the potential range of scenarios there underneath of additional imposed tariffs, what does that translate through to for your business, and what are you hearing customers already ask about now?
There's two things that I'd highlight. One, customers are looking at pulling forward freight forwarding volumes. And while that doesn't have a lot of impact on our business, what does have a lot of impact on our business is once that volume hits the ports, it either goes on intermodal or it goes over the road truck. If it goes over the road trucking, that will have a huge impact on our business. The second, as you look to see more nearshoring in the potential future, that will increase the domestic truckload for-hire trucking, which right now that market sits at $400 billion. And even post-acquisition, when you look at where we're sitting from a broker standpoint, we're just under $6 billion of revenue. So for that piece of business, we still have a small piece of a very big pie.
And so within the broader truck driver makeup right now, where are we compared to historical standards? Is there more capacity that could be filled by potential drivers? And how are you looking at the industry more broadly as a result of that?
You know, as I mentioned earlier, we're in a freight recession, and we've been at the bottom of the cycle for well over 2 years. When you look at supply and demand for where we are right now, there are far too many carriers that are in the market for the amount of demand that's there. So if you see a demand pickup, then you could see an equilibrium or even to where there's not enough capacity for demand. If you go back to the COVID years, there was far too many loads for the amount of truckers that were in the industry at that standpoint. So it's still a supply and demand right now. And when you look right now, we have more capacity than what there are loads in the network.
Interesting. Drew Wilkerson, who is the RXO CEO. Drew, thanks so much for taking the time here to break down the industry and how it flows through to your business. Appreciate it.
Thank you.
Coming up, everyone, we're taking a look at some of the stocks that are making moves on the market this morning as we're just about 21 minutes into trading. Welcome back, everyone. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. So let's go. First up, we've got AppLovin raising its fourth quarter guidance, expecting continued growth in its AI-powered advertising business. Now, AppLovin stock is up over 500% during 2024, outperforming even NVIDIA. Yeah.
That tells you something. Plus, Match Group missing Wall Street sales estimates for the third quarter and lowering revenue guidance for the fourth quarter. Paying customers for Match's dating apps, including Tinder, that saw a 3% decline, making for that marks the eighth consecutive quarter of losses. You're looking at a drop of about 15%.
And finally here, online payment processor Adyen, which counts Cash App and Shopify among some of its clients, falling after reporting slower transaction volume growth in the most recent quarter. Despite that weakness, the company's total revenue grew 21% year over year.
Well, that does it for Morning Brief. Stay with us. Coming up next on Yahoo Finance, we've got Catalyst, much more analysis on the biggest drivers of the market today. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Brad Smith. 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
All right, first up, we count you down to the Federal Reserve rate decision and preview the central bank's rate path forward.
Plus, we hone in on rates and the housing market as real estate stocks sell off following Trump's win.
And we'll hone in on how corporate America is positioning for a Trump presidency as CEOs congratulate the former president on his reelection.
The Fed's rate decision will be released at 2 p.m. Eastern time today, shortly followed by comments from Fed Chair Jay Powell. That gets underway at 2:30 p.m. Eastern time. Reporters likely to ask Powell about any changes to the Fed's outlook under a Trump administration. Markets reacting by trimming bets on rate cuts next year. Joining us now, we want to bring in Luis Alvarado. He is the global investment strategist at Wells Fargo. Luis, it's great to have you here. So talk to me about, has the fact that now President-elect Donald Trump, the fact that he's going to be returning to the White House, given what we know about his policies and priorities there, has that at all changed your expectations in terms of rate cuts?
Yeah, not much. To be honest, I think the Fed is going to be set course in what they are designed to do, which is continue to hone in on inflation. And today we're still expecting a 25 basis point cut, another one in December. The ones in 2025, maybe they're going to go ahead and evaluate. Remember that many things get said during campaign, but it takes some time for them to become policy.
Okay, so what do you think the tone is that we'll expect to hear from today's presser that could really set up what the pathway may look like for 2025?
Yeah, unfortunately, today we don't receive the summary of economic projections, so we don't get a lot of details of what the Fed discussed in regards to the economy. What we do know, of course, is coming from September, a wham, 50 basis point cut, the Fed still has bandwidth to cut. And why? Because they're still on the search for neutral, right? Somewhere between 3 to 4% is what neutral could be. Obviously, it's an academic exercise. It doesn't really become visible. But we do know that the Fed has the capacity to cut if the effective Fed funds rate is around 4.83 right now. In other words, they still have bandwidth to calibrate. They're still shooting for that soft landing. And we still think they're going to stay on course. We get inflation numbers next week. And then in December, most likely they'll go ahead and do another 25 basis point cut because they still have the bandwidth to do so before it gets a little bit more complicated for them in 2025.
Luis, what is your reaction to the market's reaction yesterday, the massive bullish day that we had play out on Wall Street? Here we are at record highs, valuation concerns maybe still there on the street. But do you think that there's enough momentum to continue this march to the upside?
Yeah, I mean, in regards to markets, I think there's still a lot of strong catalysts out there. Of course, the number one catalyst for both equities and the reason why you saw bond sell-off was expected economic growth, right? The market is still expecting some policies to probably be implemented that will develop more and inject more to the economy. So, the reason why we see a sell-off in bonds, for example, in the short end of the curve, like you mentioned, the market is paring back maybe the amount of Fed rate cuts that it had already forecasted or expected. And then the long end of the curve, yeah, the bond market is definitely expecting higher economic growth from potential policies being implemented, and then some potential inflation. So it might be a little bit complicated for the Fed. And that's why for us, having a 10-year yield above 4% makes a lot of sense, right? You add real GDP to inflation expectations, and then throw in there a little bit of a term premium from the problems that will be faced next year, which is all about the deficit, all about spending, the debt ceiling, and the amount of debt outstanding.
I mean, do you expect any of those headwinds that you just mentioned and rattled off to be abated next year?
It's too premature to know, right? With the capacity of having an administration and control of the Senate and perhaps even the House to be determined, it could become a little bit easier for the administration to probably try to implement some things. But I would say it's still too soon to know. The market seems to believe so. Equity market seems to believe so. Positioning, of course, in some of those cyclical trades, energy, financials, industrials, or doing really well kind of after we got the results from the election. So the market seems to believe so.
Do you believe so?
I think we are. Yeah, we are also bullish. I mean, from an equity perspective, we still believe that corporate earnings are going to be a big driver of equity markets continuing to rally, and our price targets for 2025 imply so. On the fixed income space, we're also favorable on investment grade corporates. We're favorable on mortgage-backed securities, even though spreads, right, the credit risk that is priced in the market right now, there's essentially no concern from credit markets, right, in regards to what's going to happen. We see credit spreads continue to trend downwards and kind of remain flat. If anything, from a fixed income perspective, we're not expecting a lot of move from where we are today in rates. We're not expecting a lot of move on credit spreads from where we are today. So the majority of the return from fixed income is going to come from income, from the yield. And that's what we're trying to hone into our clients, right? That it's going to be a special year 2025 to make sure that you're positioned well to take advantage of that coupon clipping.
All right, Luis Alvarado, Wells Fargo Global Investment Strategist. Thanks so much for taking the time to join us here this morning. Leaders of some of the biggest businesses in the U.S. congratulating Donald Trump on his re-election. Jeff Bezos was one of the first to react, giving Trump a, quote, big congratulations in a post on X. CEOs of Google, Apple, Meta, and Microsoft all following suit with their own posts online. Our next guest laying out how the business community is responding to the election. Joining us now is Bethany McLean, a Vanity Fair contributing editor. Bethany, it's great to have you back here on Yahoo Finance. So talk to us just about, I wouldn't say they're celebrating Trump's win, obviously. Some of the congratulations, there's a strategy there, right? Walk us through what you think is going on in the minds of big tech CEOs right now with Trump returning to the White House.
I don't think the congratulations that people are offering say much of anything. I could wish they were a little less fawning in some cases, but I think this is just what a CEO would do regardless of his or her personal preference in this matter. I do think the business community, broadly speaking, as you can see by the reaction of the market, is optimistic about a Trump presidency. There are the prospect of the tax cuts being extended. That's a big deal for corporate America. I think underneath that, there's also the prospect of a far less aggressive Federal Trade Commission. And corporate America has been pretty opposed to Lina Khan's aggressive stance on antitrust enforcement. And there's a view out there that has held back M&A activity and prevented venture capital and private equity exits because of fear of an FTC action. So you have also the belief of a lighter regulatory state going forward, and corporate America is celebrating that.
Yeah, I guess more so just in terms of specifically for big tech, because Trump's first term in the White House, he didn't exactly open the doors in terms of M&A deals and what exactly that looks like for big tech. Do you see that taking a different shape the second time around?
It's really hard to know what Trump is going to do, as I think everyone would agree. I think that I do expect Trump probably to be friendlier to big tech, but especially given his connection to Elon Musk and the voice that Elon Musk will likely have in this White House. But what kind of shape that takes is we're going to have to wait and see. It was the Trump administration, of course, that started to take aggressive action against Google, and so we'll have to see. It'll be really interesting. It'll be really interesting to watch what happens at the FTC. I think that will be a leading indicator of the attitude that this administration is going to have toward big tech.
Yeah, and let's also throw into the conversation why there was some of that activity taken against Google. It was because the party was upset about them showing up in search rankings differently than the opposing party. And so that would point us back to some of the retribution, the kind of vindication that Trump was looking for against publicly traded companies and entities. And so are these leaders, are they fearful and just trying to preempt any type of retribution for them not coming forward and congratulating Trump and trying to get into good graces?
Absolutely. Trump does have a very strong retributory, is that a word, streak to him, as we all know. And I'm sure that CEOs are scrambling to get out in front of that. At the same time, one of Trump's scorecard, perhaps his major scorecard, is the stock market. And so if any of his policies start to negatively impact the stock market, I think you would expect to see him switch course. So I think about that with his promises to chop away at our bureaucracy. So federal spending contributes a lot to economic growth. If he starts chopping away at the bureaucracy, and that is contractionary for economic growth, growth, then you can expect to see perhaps a change in that, because Trump's scorecard again is the stock market, and so that implies perhaps a lack of consistency in the positions he might take.
Bethany, just quickly while we have you, Elon Musk has really been like a right-hand business person for President Trump, President-elect Trump, going into the campaigns. And here's them, of course, sitting together at just one of many instances where they have connected and spoken with one another. They've campaigned together. All of this said, Elon Musk has also talked about $2 trillion worth of cuts that he would look to implement and help Trump do once he takes office. What do you think that essentially looks like as a playthrough economically, and then as well to what has been his perhaps North Star, which is the stock market?
Right. So that is, I guess, big picture. I do not love the idea of someone who is unelected having this much power going forward. That's one of the disturbing aspects of this to me. But I think that's going to be one of the cruxes of the issue that we see going forward. If Musk does indeed start to implement this with the Trump administration's backing, and that becomes contractionary for the economy and therefore a negative for the stock market, does Trump stick with that? Or does he reverse course because his major scorecard is starting to give to flash negative? So I think that's one of the issues we should all pay attention to going forward. I think another big one, I'm a little less sanguine about what the bond market is signifying than perhaps other people are. Interest rates where they are now, okay, not a problem for equities. But if interest rates start to show fear of not just inflation under Trump, but also recklessness with the federal debt and deficits, that will be another factor that could turn quite negative all at once. So I think we should pay attention to the divergence between the stock market and the bond market and what each might be telling us about the future.
All right, Bethany McLean, thanks so much. Coming up next here on Catalyst, we're taking a look at some of today's top trending stocks. Strong streaming growth for Warner Brothers and Lyft soaring after its earnings report. We'll give you the news behind those moves next on Catalyst. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at Warner Brothers Discovery reporting record streaming growth in the third quarter, adding 7.2 million global subscribers. Still though, revenue missed expectations, struggling with a drop in its studios and TV business. Yahoo Finance's Alexandra Canal joins us a closer look at this. And Allie, despite maybe some of that disappointment, we are looking at pretty strong gains today.
Yeah, double-digit gains. A lot of that has to do with that streaming growth. We saw profits come in ahead of expectations, higher on a year-over-year basis. We also saw that the subscriber count, as you mentioned, hitting a record amount of net additions in the quarter and a beat compared to estimates of 6.1 million. Also, if you take a look at the year prior period, we saw 700,000 subscribers actually lost in that period. So a significant gain there. And this comes as we've seen Max roll out their subscription service in markets outside of the U.S. So a lot of strength overseas. We also have the release of key programming like the second season of House of the Dragon, along with the Olympics aiding that as well. But like we mentioned at the top here, revenue was still pressured. We have a free fall in network ad revenue that actually dropped 13% year over year after dropping 10% in the second quarter and 11% in Q1. So we continue to see that bleeding there. You mentioned studios, the comps there with Barbie from last year, disappointing. But when you think about the future of this company, the loss of the NBA rights, it's all in question. And that was actually addressed on the earnings call. CEO David Zaslav, he said that the company is looking at all opportunities, both operationally and strategically. He also said that the current Trump administration could possibly provide more opportunities for consolidation. He said that as things stand today, it's just not sustainable. There are just too many players on the market, too many subscription plans out there. We were just talking about in the break how we don't even know which subscription plans we're subscribed to. So from a user standpoint, it's not the best experience. And because of that, Zaslav says consolidation has to happen. It's just a question mark of which players are going to survive.
You know, that's such a good point because we talk about, especially this week, obviously, what President-elect Trump, what his priorities are going to be, how regulations, how his policies are going to play into all that. I guess I'm curious just how much that could potentially speed up that timeline because consolidation is something that you and I have been talking about for years within the industry.
Yeah, especially with the streaming landscape. I do think that we've started to see a little bit of that with Paramount, the Skydance deal. Of course, we need to still see if that will eventually be fully approved and get off the ground. But at this point, it seems like, yes, Trump as a leader has been viewed as more friendly with M&A across multiple industries, not just with media. So I do think that we're going to see more activity. A hinder to that could be if things go wrong with the economy, high interest rates, that's all things that these companies are considering. But it does feel like we're at a point in time where every single media giant is thinking about this. We just heard from Comcast, too, that they're exploring possibly spinning off their cable business. So it's something that is on the minds of legacy media. It's just a timing question, I think, at this point.
All right, Allie, great stuff. Thank you.
Thank you.
Let's turn to the autos market. We're taking a look at Nissan cutting 9,000 jobs and 20% of its production capacity after reporting weak sales in the U.S. and China. The Japanese automaker slashing its annual profit outlook. Despite all that, you're actually looking at gains today, up just about 2%. Pras Subramanian is here with more on the results. And Pras, that long list that I just ran to, it doesn't sound good here for Nissan.
It doesn't sound good. We saw the stock move up a little bit higher, but I guess it's just sort of recognizing that Nissan is trying to right the ship, but they're not in a good spot. Like, it's no two ways around it. We mentioned for the quarter revenue and profit down. For the first half of the year, fiscal year, operating profit down 90%, right? So this is just not what investors want to see. It's not surprising they cut their outlook, so that's all sort of happening. I mean, operating profit will be nearly a fourth of what it was last year. So that's what we're talking about here. So they're cutting the jobs, 9,000 jobs, 20% of the labor force. Maybe just needed to kind of right size that. But I'm just looking at U.S. sales here. Like, so for instance, they have a new Nissan Kicks and new Nissan Rogue, brand new cars, affordable SUVs that are they're bread and butter. The Kicks is down 6% in the U.S. In Q3, and the Rogue is down 24%. So they're just not resonating with buyers right now. So that's a big problem for them.
Yeah, and that's something that obviously takes time.
Yeah,
just in terms of righting that ship. Pras, while we have you, I also want to talk about Stellantis because we did get some layoff news there. They're announcing layoffs at a Jeep plant in Ohio. What is this signal just in terms of that strategy then?
Yeah, I mean, this is just the next sort of domino for them. They knew they had to cut inventory. They knew they had to cut supply. They knew they had to cut costs. And this is happening with their Jeep Gladiator plant in Toledo, Ohio. That's that pickup Jeep Wrangler, cutting down one of the shifts down now to only one shift at that plant. That's 1,100 workers that are laid off indefinitely for that vehicle. And again, they're trying to improve their supply. Look at GM, for instance, right? GM did a smart thing. They kept their supply down. They have the right kind of trucks and SUVs that they know people like, and they eased into EVs with a portfolio across a number of prices, right? Stellantis still hasn't really rolled out their EVs. They have a few vehicles here and there. And Jeep, their bread and butter, their money maker, they made too many of them. And now they're having to cut back supply, and they cut prices tremendously to sell them.
Yeah, they have. And I mean, I'm getting served promotions on my Instagram all the time. How much is that expected to eat into profits here this year? Because it sounds like it's an issue that's not going to go away anytime soon.
I think this year it's already been recognized that that's going to be a big problem as they trim that inventory. But looking ahead, I've already seen that they've actually, for the 2025 model years, they've actually cut the MSRP. So not doing incentives. They brought the MSRP down, and they're limiting supply. So that should help get them in the right spot where they have higher profit margins. That's the goal.
Yeah.
I think that's what's happening. So 2025, Jeep Grand Cherokee, maybe take a look.
All right, press. Great stuff. Thank you. Finally, we're looking at Lyft today, soaring as third quarter sales top estimates. Active riders up 9% from a year ago. The rideshare company also issuing strong guidance for the current quarter and full year as it attracts more commuters. Joining us now, we want to bring in Bernie McTiernan. He's Needham & Company's managing director. Now, Bernie, this is a very different story than what we heard from Uber just last week. What does this show just in terms of how much ground, or is Lyft maybe gaining significant ground against Uber?
Yeah, well, no, it was a great quarter. We're looking for about 15% bookings growth in the second half of the year now. I mean, for Uber on a relative basis, they grew 27% in the second quarter, expected to be low 20% range in the fourth quarter. So, and that's on mobility. So Uber's still growing faster, but Lyft is making great inroads. You mentioned on the commuter. So commute rides is about half of the rides during the week. And they launched this price lock guarantee, Lyft did, that actually increased frequency 4 times what they normally get from those commuting hours. So Lyft, the problem for Lyft is that everyone knows what Lyft is, but they need them to actually to get further down the funnel and actually engage with them. So we like that Lyft is really focusing on specific products, specific use cases, partnership with companies to try to really drive that conversion. And seems to be working so far.
It does seem to be working. I guess how much more growth opportunity do you see there with that new Fare Lock offering?
Yeah, we'll see. It's still really early days. And again, it's a big part of the the amount of rides that Lyft has. And it really speaks to this new management team. They've come in and done a really terrific job. Really, they've only missed 1 quarter out of the gates. That's a stark contrast to what we saw from the prior company. And then that's what gets you to think about their long-term targets. And we're still a substantial discount in terms of that 15% CAGR that they guided to in terms of getting to $1 billion of EBITDA. And so as you keep, marching along these goals that they have on the short-term basis, it makes that longer-term goal, seemingly more achievable. And Lyft is already looking, pretty cheap on a relative basis, relative to Uber, relative to DoorDash, on 25 EBITDA, and then obviously just a lot cheaper if you look out to 27 and beyond.
Bernie, how big of a catalyst do you see this new partnership with Intel's Mobileye and May Mobility here as it does gear up for those robotaxi services?
Yeah, so Lyft reported 3 AV partnerships this week. We think AVs in the rideshare world is going to be an asset-light approach. So then, therefore, partnerships is key. It's partnering with a diverse set of companies. This is the same strategy that we're seeing Uber do, albeit Uber's with Waymo, which is best in breed in terms of who you want to partner with. But that's what we want to see. From Uber, from Lyft, is to continue to partner with companies, continue to roll out this technology in more regions, more cities. And again, we think ultimately this should be a TAM enhancer. This should reduce the price of rides over time. And again, it's partnerships that are going to get them there from a technology perspective. But it does bring up Lyft. With the last guest, you've spoken about what this Trump administration could mean. I think M&A is something we have to be on the lookout for. In Lyft, you had Uber. Partnerships are becoming more of more of the game in terms of these consumer-facing marketplaces. So you have Uber partnering with Instacart, you had Dash and Lyft announced last week. I wonder if this Trump administration again could be the catalyst to finally get some real M&A in the consumer marketplaces.
Do you see Lyft acquiring a smaller company, or do you see Lyft being an acquisition target?
I think they could be an acquisition target, either from a marketplace or from a technology provider as well, to realizing the value of their, the value of a marketplace as you're rolling out technology. I mean, we'll have to see how everything shakes out, but I think you have to put a higher likelihood on that today than you did 2 days ago.
Any potential buyers? I guess more specifically, who then would be interested? You
well, so Dash always comes up. Tony's been pretty transparent that he doesn't want to buy Lyft, but we'll have to see. We certainly didn't see that partnership coming. But then again, going back to, is there a technology provider that wants a ride-sharing marketplace to stand up their technology?
Bertie, I also want to talk to you about the Massachusetts voters approving giving union rights to drivers here, not only for Lyft, but also Uber when you talk about these ride-hailing services. I'm curious just in terms of the implications here for Lyft, just if we do see more states go this route, how big of a cost disadvantage would this be for Lyft?
Yeah, certainly one of the things that Lyft has been doing really over the past 6-12 months is increased driver pay transparency, making sure that they're giving the driver 70% of the bookings net of some of the expenses of the platform. So they've been trying to move in terms of the right way. And one of the things they actually mentioned on this earnings call is because of some of these transparency measures, both on pricing and because of the actual drives that they're showing the driver in terms of, whether it's the actual take-home pay the driver is going to be getting, or from an EV perspective, how far the trip is from like a range anxiety perspective, so the driver can feel comfortable, showing the driver more transparency there, and that's actually leading to more driver preference towards Lyft. So, certainly something we'll have to continue to watch in terms of how these states shake out on an individual basis, but something the company has been very much focused on.
All right, Bertie McTernan, Needham & Company's Managing Director. Thanks so much.
Thanks for having me.
Keep right here on Yahoo Finance. Much more of your market action ahead. Again, you are looking at gains across the board. The S&P up another 0.5% today, getting closer to that 6,000 level. We'll be right back. President-elect Donald Trump said to meet with his transition team today, where he will begin the process of choosing his cabinet and other high-ranking administration officials. We're also still waiting to see whether or not Republicans will gain full control of Congress. Over 36 House seats still uncalled. The Associated Press currently calling 191 seats for Democrats and 206 for Republicans. It could, though, be days before we have the final count. Joining us now, we want to bring in Ishai Akabis. He is the Executive Director of Economic Policy at Bipartisan Policy Center Program. And also Steve Clemons, the founding editor-at-large for the Washington Note. Great to have both of you. Steve, let me start with you when it comes to the cabinet. We certainly do have this scramble going on right now, it seems, for President-elect Donald Trump to fill the cabinet. Lots of questions about who those names are going to be, who exactly could be in line. What do you think?
Well, there are a lot of names out there floating, and people are scrambling to make sure that they're, on the list one way or another, because that could help their private sector fees go up if they're rumored. But I think for the Secretary of State and Defense Department, there are a lot of the same names that we've seen kicked around. Mike Pompeo would be potential Secretary of Defense. You've got Lindsey Graham, Senator Graham, Tom Cotton from Missouri, Senator Cotton, and the other Senator from Missouri, Josh Hawley, are talked about as potential defense secretaries or even secretaries of state. Rick Grinnell, who's become very, very close to the Trump family, former director of national intelligence, acting director, I should say, former U.S. ambassador to Germany, is someone who's also looked at. He's been kind of playing envoy for Donald Trump through this whole campaign. So Rick Grinnell is another potential in that space. There are other interesting people out there like Bob Lighthizer, who was Donald Trump's U.S. trade representative, might be Treasury Secretary, or John Paulson, famous from The Long Short. He made zillions of dollars during the subprime crisis, and is someone who put a lot of money behind Donald Trump. So I could keep going like that, but those are some of the names that are percolating in my space.
How likely do you think it is that we'll see Elon Musk among the cabinet members?
Look, I think Elon is in a complicated position. For him to get a Senate confirmed position, I think he'd have to pretty much divest himself from a lot of his assets that define him, like SpaceX, like Tesla. And I think, I think that the money is more on Elon getting a kind of advisory role that it really, the power of those kind of roles is dependent upon your relationship with the President of the United States, not necessarily how formal your role is within this. So I think it's highly unlikely, and probably he would face a lot of interesting confirmation hurdles if he was to go through that process. So I think he'll be in a more advisory role, but he'll have power because Donald Trump listens to him.
Well, speaking of Elon Musk, Shai, I want to bring you into the conversation because one of the, seems like at least on Elon Musk's agenda, would be cutting spending. He talked about the fact that he wanted to cut $2 trillion out of spending. He posted the picture on Twitter yesterday with the kitchen sink, very reminiscent of what we saw after he took over Twitter. I'm curious from your perspective, just first, let's just start with what Musk has laid out. $2 trillion in spending to cut, obviously, that's a heck of a lot. How realistic are some of these goals?
Yeah, so making spending more efficient in the federal government is certainly an admirable goal. The challenge will be that most of the spending that we do from the federal government is on autopilot. So this is things like the mandatory spending programs, Social Security, Medicare, Medicaid, net interest costs, the interest that we pay on the federal debt. You can't cut that. That is money that we owe to the other countries and investors that are lending us money. So when you cut it down to, or when you boil it down to the portion of the budget that is renewed on an annual basis that goes to discretionary accounts, you're talking about less than 15% of the overall budget. Even if you eliminated that entire part of the federal spending, which encompasses most government agencies, you would not solve our fiscal challenges that we have today. So our focus is going to need to be more expansive than that to get ourselves on a sustainable fiscal path. That said, I do think there is room for looking at those government agencies and finding places to save.
Where do you think would make the most sense?
Well, I actually think we need to be focused on the other parts because those are the bigger pieces, and the tax side of the equation too, which obviously will rear its head next year with the expiration of many of the tax cuts from 2017. Next year is really an inflection point on fiscal policy. We know that there are going to be moments where legislators and then the executive branch in partnership with them are going to have to confront this topic. There's the debt limit that's going to be reinstated on January 2nd. That will kick off a series of negotiations around that issue. There's the appropriations process, which we still have not finished for the fiscal year that has already begun as of a month ago. That's likely to carry over into next year. And then the Tax Cuts and Jobs Act provisions expire at the end of 2025. Those debates are going to go throughout the year, and we have an opportunity to have the two parties work together to make progress on these critical issues that will affect the future of our fiscal policy and our economy. But there's also a chance that things go south, and we keep digging the hole deeper. If that happens, excuse me, we could be in for a rude awakening among markets who are already showing that they are losing patience with our inability to deal with our fiscal challenges.
Steve, I'm curious just to get your thoughts on the turnout that we saw when it comes to the election, what that really signals about the Democratic Party going forward. Clearly, there has been the talk or the narrative, at least yesterday, we were talking to so many political strategists and even economists. They were talking about the fact that there's clearly a frustration here with where things stand with the economy. In terms of some of the policies that Trump has laid out, is there a risk then, so let's be careful what you wish for, inflation could actually get a lot worse under a second Trump term?
Well, yeah, I mean, that's true depending on how they shape things like tariffs that Donald Trump talks a lot about, and whether they become so widespread, you're essentially, raising costs and prices 10% across the board in the consumer sector. But I think that the bottom line is the Democratic Party lost big. This is a huge win for Donald Trump. He has a real mandate to figure out what he wants to do. And I think in that space, when it comes down to the working class of America, they feel abandoned, demeaned, I think left behind by a lot of the sectors that were supportive. Really, both parties. I mean, I think the New York, kind of financial world was one that many Americans feel was working against them as working Americans rather than for them. So there's been a huge shift away from the Democratic Party of the working class of America towards Donald Trump. And I think he's got to figure out. That's one of the reasons why I think he talks a lot about tariffs, because that will create some protection for industries that might be building nascent manufacturing capacity, expanding jobs. But also immigration is about the working class to some degree. If they can, shut down a lot of the immigration, particularly from the southern border, that will help put upward pressure on wages of those workers.
All right, Steve Clements, Shai Cabas, thank you so much for taking the time to join us here this morning. Coming up, China's stimulus hopes raising stocks today. With 4 more years of Trump on the table, Beijing could take far bigger steps to boost its economy than previously thought. We've got more on that coming up. Chinese stocks hitting a one-month high today as stimulus hopes and stronger than expected export data boosted sentiment. The jump coming after Trump's election victory and the threat of steeper tariffs rattled Asian markets on Wednesday. Joining us now to break it all down, we want to bring in Shahzad Kazi. He is China Beige Book International Managing Director. Shahzad, it's great to have you back here on set. So there's a lot to talk about this morning. I'm curious just to get your thoughts on some of the optimism, I guess you can call it, playing out on the hopes for more stimulus and whether or not it's going to be enough to offset some of these concerns here about a second Trump administration.
Yeah, I think we have to figure out what that stimulus is really going to be about. I think some of the more bullish voices are probably going to be disappointed because what you're about to get, I think, is a big chunk of money which is really going to be spent on recycling debt in China, which is a classic way they handle bad debt problems in the country. You're not getting a more muscular housing rescue package. You're certainly not getting a consumer or household-focused stimulus package of the nature even that we are used to out here in the West. So I think we need to keep our expectations modest for now while realizing they want to save some of the firepower for the future.
How seriously are they taking the threats from a potential second Trump administration when you talk about 60% tariffs across Chinese goods?
I think they're taking the threat very, very seriously, which is why they probably want to make sure that they've got the fiscal power or the firepower ready when Trump tariffs do go into effect. But, on the other hand, I'm sure in the back of their minds they're thinking, we got a pretty good phase one deal. Can we do it a second time around?
Do you think they can?
Possibly. I think anything's likely with the Trump administration, especially the president himself.
What about the potential backlash here, just in terms of the tit for tat that we have seen, especially during the Biden administration? Talk about that maybe carrying over once again to the Trump administration. What maybe does that more specifically look like?
Yeah, again, pulling back, 30,000 feet. The Chinese have very few options as compared to what the U.S. has. That's just a fact. Now, that said, they can do export controls on critical minerals. They can start saying we're putting certain Western companies on blacklists. So they can start going after certain very, very important American corporations and have those CEOs show up in D.C. and start whining and complaining and pushing the president to take it easy. But I think their toolkit at the end of the day will be limited. If President Trump comes in with this team and wants to go very, very aggressive, I think there's going to be a lot of pain felt on the Chinese side.
Let's take a step back and talk about the Chinese economy more specifically. I mentioned some of that data that we got out this morning. China's export growth surging in October, the fastest growth that we've seen since July 2022. We're hearing the Chinese slowdown here just in terms of a sluggish economy on more and more earnings calls. It seems like this time around. What's the state of play right now?
Yeah, look, I think the Chinese economy has been nowhere near a crisis all year long, which is why, by the way, you're not getting sort of this bazooka-style stimulus. The economy was slowing down. October, as a matter of fact, saw a bit of a rebound in certain sectors. But what you're getting in the exports data, especially on the commodities and steel side, is, that problem of China dumping its goods abroad, especially on the commodity side. And yes, on other manufactured goods, you are getting some growth being pulled forward right now because companies here, of course, are concerned about tariffs next year.
When we talk about what this turnaround is going to take, how long until we get a little bit more momentum? We talk about the extra stimulus efforts, still obviously a lot of uncertainty, but how long do you think this is going to take to play out?
Look, I think we're not getting blockbuster GDP numbers out of China anymore. Right. That's for sure. I think we're getting sub 5% growth well into the next several years, and it only slower from that point onwards. That said, I think next year could possibly look good if the housing market finally stabilizes. I think that could be a very, very good tailwind for consumer spending in China, just as potentially the manufacturing sector starts to come under a little bit of pressure.
Is it going to be, I guess, good enough, strong enough to attract those foreign investors?
I think there's upside there, and I think foreign investors are starting to get a little excited about at least the economy stabilizing. That gives them a little bit more certainty than they've had for a while.
Where do you see, I guess, the most opportunity? Maybe it is the property sector, but where do you see the most opportunities? You talk about that turnaround strategy and where maybe we are going to generate some of that interest.
I think we need to think about, what's going on with sectors that the government really favors. So what's going on with maybe some of the elder care, and maybe they do decide to put some money behind that kind of stuff. But otherwise, I think consumer spending, right? We have to monitor it very, very carefully. Do Chinese families take more trips? Do they maybe finally go abroad next summer? They have been spending internally. So I think tracking those dynamics is going to be good. I'm still not betting on luxuries doing phenomenal next year. It got battered this year.
All right. Shahzad Kazi, great to have you. Thanks so much for taking the time to join me. All right, coming up next, we will be taking a look at the housing sector. Home builder stocks are still processing the results of the election yesterday. You're looking at a mixed picture up on the screen. We've got more on that when we come back. Shares of real estate company Zillow trading higher this morning after beating the street's expectations in the third quarter. You're looking at gains of just about 21%. Zillow reported $581 million in sales, a 17% increase from a year ago. Now, despite overall slower home sales across the U.S., its rental revenue did rise nearly a quarter year over year for total sales of $123 million. Multifamily rentals seeing revenue increase 38% from a year ago. Now, Zillow's mortgage business also growing 60% during that time. Across all apps and sites, Zillow reporting 233 million unique monthly average users. Looking ahead to the fourth quarter, Zillow CFO Jeremy Hoffman saying that the company expects continued growth in rentals as home affordability cuts into potential buying activity.
We expect that the housing market will continue to bounce around at current levels, implying modest year-over-year growth in the fourth quarter. While there continues to be pent-up desire to move, affordability remains a challenge. Our Q4 outlook takes this into consideration. We expect our rentals revenue to grow in the mid 20% range year over year in Q4.
All right, let's stick with housing. Real estate stocks were the S&P 500's worst performing sector on Wednesday following the election outcome. Amid the potential for higher for longer rates, also Harris very much viewed as a potential boost for the sector given her focus on housing affordability. Here to break all of this down, what ultimately a second Trump presidency means for the sector, we want to bring in Rick Palacios Jr. He's a John Burns Research and Consulting Director of Research. Great to have you here, John. Rick, excuse me. Thanks so much for taking the time. Talk to me about the home building sector under President-elect Trump. Clearly, there were some concerns playing out in the real estate market yesterday. How worrisome should investors maybe be?
Yeah, thanks for having me, Shauna. I think the reaction yesterday was mainly the reaction to interest rates, and you could clearly see that 10-year rates blew out. They've come back a little bit today, and I think the biggest issue for housing across home building and for sale on the resale side over the last year or two has just been affordability. And so the entire space would prefer to see a 6% mortgage rate, not a 7% mortgage rate as we go into the spring selling season. But it looks like the economy continues to chug along, and now we know who won the election, and the odds are that we may be closer to a 7% mortgage rate as we go into 2025.
So how challenging then is that road ahead for home builders?
How much of a headwind is that for home builders? So here's an interesting thing. We just surveyed, and we do this monthly, about 300 home builders across the country, and sent this out to clients yesterday, and they told us exactly what happened for October. And October sales were actually better than we anticipated, as well as the pace of construction on single-family housing starts. And so this is interesting because you think about the lead up to the election in October and the uncertainty that a lot of people are talking about with consumers and buyers and also home builders on earnings calls recently. And then mortgage rates backed up to 7% all the way through the end of October. And then we had some hurricanes across Florida. So that was a promising print for us, and it's an early leading indicator for what will show up in the census numbers later this month. I think what we know for sure, though, is that because mortgage rates are 7%, incentives are driving a lot of those sales. So home builders are having to do a little bit more on the incentive front to push those sales. And it's different region by region. And this is something that I think following the home building earnings over the last couple of weeks, and they were only reporting through September and then alluding or talking about what was happening in October with incentives. And we clearly saw that push in our home builder survey.
John, Rick, excuse me, I keep calling you John. John Burns.
No, it's okay.
Rick, when we try to figure out, I guess, how big of an impact this could have on home affordability, housing affordability, clearly that was the key focal point in the economic agenda that we got from Harris. From Trump, we haven't heard too much. Do you think, how optimistic are you that that is going to become a focus here for the Trump administration?
So, I mean, the way that we look at it is how much of it is rhetoric versus reality. And I don't think any of our home building clients are planning their businesses around Trump versus Harris, and now we know it's Trump for 2025. What I will tell you, though, is that, again, going back to that home builder survey, where every fall, as we get closer to the new year, we ask our clients, what are you anticipating from a growth perspective for the following year? And there was some clear optimism on growth when we just asked about 300 home builders, where they told us we think sales as well as single family starts across our footprint are going to be up about 10% in 2025. And so I think what that brings me back to, in all the research that we've done over the years, is that the housing industry, home builders, the resale market would much rather prefer a steady, strong economy, even if it's at slightly elevated rates, than super low rates and it's for a bad reason, meaning there's a recession. And so I think history tells us that if we're at a 7% mortgage rate, affordability will be bad. It'll be a slow grind next year in that environment, but I think if the economy holds up, most of our clients would be okay with that.
Rick, I want to ask you about the Fed before we let you go, because I think so many of our viewers are trying to figure out why the Fed, now that it has begun its rate lowering cycle, why that hasn't been a bigger boost for the housing market. Talk to us about the correlation there and why we aren't seeing a bigger gain.
Yeah, so happy Fed Day. That's going to show up later today. Yeah, it was a bit of a head scratcher for a lot of our clients, and I think consumers especially, because everybody was antsy, waiting for the Fed to cut. Then they did on September 18th. And lo and behold, mortgage rates blew out. And I think what the conversation we're having right now really tells us is a big driver of that is because the economy continues to remain pretty strong. And so if the economy is healthy and strong, and then now you maybe have an administration that could lean a bit more inflationary, that means 10-year Treasury rates are going to hang out at these levels. There's no real reason for them to fall anytime soon. And so the Fed can do what it's going to do, and maybe they cut 25 basis points today, maybe they hold, who knows. But the reality is that's going to drive the short end of the curve, not the long end of the curve. And that's kind of where we're at right now. And it's the long end of the curve that matters for mortgage rates.
All right, Rick, great explainer. We have to leave it there. Thanks so much for joining me here this morning.
Yeah, thanks.
Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, the Fed is announcing its latest policy decision today. Widely expected to cut interest rates by 25 basis points. We'll discuss what the anticipated cut means for your money. And we'll talk to industry experts about what a Trump presidency, once again, means for markets and small businesses this time around. Plus, it's open enrollment season, and we're talking to our very own personal finance guru, Carrie Hannon, about the benefits of having an HSA. All that and much more over the course of today's show. But first, let's take a look at some of the market action. We're 90 minutes into the start of trade, and stocks, they are higher today ahead of the Fed's interest rate decision out this afternoon. And as the dust settles after the election with former President Trump set to take back the White House in 2025, should you be reevaluating your portfolio? To discuss all of this and much more, we've got Matt Powers, who is the Powers Advisory Group managing partner here. Matt, thanks so much for hopping on this morning with us. As you're considering some of the trades that transpired post-election, as some of the uncertainty has now been removed from the tape, and now a little bit more focus on what has already been kind of telegraphed from the Fed in the cutting cycle that they've entered into, what do you believe is set to transpire from this point forward, and what are some of the top trades that come to mind?
Yeah, good morning. Thanks for having me on. So yesterday's rally, let's hit that first. We saw the Trump everything rally, you could call it, even though the market didn't exactly show this with real estate, utilities, and staples down, but there's a pro-growth, pro-deregulation mood among investors. And I mean, expectation for more tax cuts. We look at it as a relief rally, meaning investors were simply glad we got results regardless of outcome instead of waiting for days or maybe even weeks. And once euphoria settles from all this, and with the election over, there's quote unquote new uncertainty. So a lot of changes are on the table with the Trump victory, and we've seen this time and time again that the market doesn't like uncertainty. So we see really a raised level of volatility in the near term here.
What does that choppiness look like, and what are the sectors that you think could be most impacted?
You know, it's a couple things there. So the Fed rate cut obviously is here in a couple hours, hopefully a rate cut, but it'd be a more significant headline, but not quite as much because of the election and the consensus that we're going to see that. But so sectors, we like the possibility of the deregulation of banks, and it should spark the financial sector, should benefit both large banks and regionals. Oil and gas will likely benefit. Energy stocks rose quite a bit yesterday, but on expectations of pro-industry policies, clean energy is probably going to continue to suffer in that area. In tech, there's always tech out there.
You know, as you think about the headlines and what they're talking about deregulation, how could that play out within the equities market? And how would you evaluate the equities market even versus some of the bond reaction that we've seen recently as well?
Yeah, so this is kind of left turn here, but over the past, if we're going to the election and some deregulation, regardless of that, this is interesting. Over the last 25 elections, 1-year returns were positive 10 out of 13 times after a Democrat win, and 9 out of 12 times after Republican. And over 4 years, both parties mostly saw gains. So kind of cutting through that noise a little bit, some of the deregulation in the markets, we like it. One thing on the tech end that is a concern is the tariffs. So that is potentially a negative impact, and it could affect the profitability of hardware and semi companies. So China tariffs specifically.
And so with that in mind, for investors that are trying to get ahead of any additional tariff type of impact, how could they create a perhaps barbell approach or even just a hedge against what those potential tariffs might look like?
Yeah, going back to tech, it's Trump supports reducing regulations, in particular AI is the spot. So cloud could definitely benefit from, cloud service providers could benefit. So we recommend, if we're looking at companies, maybe staying away from Apple temporarily, but Amazon, Google, even Microsoft within that Mag 7 block of companies. Financials, another area, just had one of their best days in 2 years. The XLF, kind of a broad-based approach, is an ETF that we like, and it's got exposure to financials. And top holdings are primarily large banks, credit cards. The number one holding in there is Berkshire Hathaway.
Just lastly, while we have you here, Matt, it was interesting, and it was pointed out with one of our conversations this morning from a strategist over at Bloomberg who was talking about how healthcare reacted differently post 2016 than it did here in 2024. And in both instances, a Trump win for the White House, but a different reaction as opposed to 2016 because of how he's talked about kind of what they would do and what he would prioritize or deprioritize within healthcare as well. Where are your kind of anticipations within that sector going forward from here? And why do you think there was that difference in reaction?
We've always liked healthcare. We have all year, and it's not just pharma. It's, from the beginning of the year, one company we liked, and it really hasn't kept up, is Medtronic, and that's a medical equipment company. So they had a huge day yesterday, healthcare across the board. We saw that, and, again, kind of shocking, kind of a surprise, especially when you see other sectors that are kind of traditionally defensive, maybe not follow suit. So, looking forward, I think clearly healthcare, if you're going to be sector allocated, is an area you need to look in. We're a dividend growth firm. That's kind of our focus. And traditionally, a lot of those companies are dividend growers. So, there's a lot of them that we do like.
All right, Matt, thanks so much for taking the time here with us today. Matt Powers, Powers Advisory Group Managing Partner. Appreciate it.
Appreciate it. Thank you.
It's time to check on today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Let's kick things off with SolarEdge, getting a downgrade from Bank of America. The firm citing President-elect Trump's possible tariff plans as a risk to demand for solar trackers. Guggenheim also downgrading Sunrun and Sunnova, citing similar risk to investing in energy transition companies with respect to policy and trade outcomes connected to a Trump presidency. Let's also check in on Dutch Bros. The coffee chain rising after revenue and adjusted earnings per share. It came in higher than expected during the third quarter. The company also boosting its full-year revenue outlook. Analysts at JP Morgan and Stifel plus Wedbush, among others, boosting their price targets on the stock. Shares are up by about 10% over the course of 2024. And finally, the Hershey Company cutting its full-year sales outlook, citing high cocoa prices and a challenging consumer environment. Now, the company sees flat sales growth in 2024. That's down from 2% in the prior guidance here. Now, the chocolate giant missed on revenue and profit expectations during the third quarter, and cocoa prices are down from their peak this year, but they remain elevated historically. The Fed's policy decision coming down later today could have a big impact on your wallet. 97% of interest rate traders are pricing in a 25 basis point cut, according to CME FedWatch. Here with more of some of the money moves that you can make as rates come down, we've got Lee Baker, who's the founder of Claris Financial Advisors. Lee, good to see you here. Thanks so much for taking the time here with us today. And so your anticipations going into the Fed decision this afternoon?
Yeah, consider me a part of that 90-some%. I expect 25 basis point cut. The shocker would be anything other than doing that. The Fed has been following the data, and based on a still relatively strong job market, although softening, and the fact that interest rates have continued to drift downward, I expect them to cut it by 25 basis points.
Okay, and so what is the tenor that you expect to hear from the Fed in the press conference just about the pathway forward from here?
My expectation will be a lot of what we've continued to get. A lot of caution. They're forecasting the direction. The anticipation would be more cuts into the future, but a continuing trend by the Fed to watch the data. So as we approach, the holiday season, what does consumer spending look like? What does the job market look like? Are there any adjustments or revisions as we have more time to absorb damage by the hurricanes that have come through Florida? Just a whole host of things. But I think the tenor will be to continue to move in that direction, but with the caveats, and there's an abundance of them, that we're going to continue to monitor the data and make moves accordingly.
And so as you're thinking about going forward from here and that pathway that you were kind of laying out, a lot of focus on the terminal rate and what that could look like. Of course, we're not going to get the SEP this go round, but as we think about further out down the line, it seems like somewhere between 3 to 4%, and ultimately, if we kind of stick with that midpoint at 3.5% for a terminal rate, does that mean that we could see cuts every quarter next year, 2025? I mean, what are you ultimately baking into your own projections?
Yeah, so my projections, making a couple of assumptions. One, that we remain on the current glide path, if you will, where the economy continues to be healthy, perhaps not growing gangbusters, which, quite frankly, I think might cause the Fed to kind of go, hey, wait a minute, we're going to pump the brakes on these cuts. But because I think we've got a market that continues to be healthy, although slowing down, inflation continuing to trend in the right direction, my expectation going forward, at least to the near to medium term, is a series of small rate cuts as we move along.
So what do the rate cuts mean for people who are carrying debt right now?
Yeah, so here's what the rate cuts mean in from a debt perspective. If we make the assumption that my thesis is right and we get some more rate cuts, people that have credit card debt, I think, will benefit more as we move along. Most credit cards, you've got floating rates, and those rates are pretty high in recent vintage, if you will. But I think they can expect to begin to see those rates trend down. You had some folk on talking earlier about mortgage rates. A little bit of a difference because it's pegged to a different end of the market from a rate perspective. But consumer debt, I think people will begin to see that trend down over time.
And then I guess for savers as well, what do following rates mean for savers out there? Is this a good time to lock in CDs?
Absolutely. So if you're a saver and you're taking a look and saying, hey, I've got this money, I've enjoyed the fact that I can get this 5% return on my investment, my encouragement to those folk would be that if you've got some CDs that are expiring soon, or if you're literally sitting on some cash, now is probably a really good time for you to go ahead and lock in those interest rates. Because I think the era of 4.5%, 5% interest rates are going to fade slowly into the background, barring some potentially unforeseen circumstance out into the future that causes the Fed to reverse course.
Lee, within your notes to us, you mentioned the current consensus is for more rate cuts to come, but keep an eye on how President-elect Trump operates here. From what you've heard on the campaign trail and now even kind of setting his sights on once he gets into office, what does that hold for economic impact as it relates to what the Fed and their dual mandate are really focusing in on?
So, here's the concern or the caution, right? I imagine a lot of people have heard this idea that potentially across the board tariffs. Most economists will tell you that that is inflationary. If you look at some of the tax cuts, we are in a fairly low tax environment right now from an income tax perspective. My assumption with a Trump presidency, control of Congress by Republicans, definitely in the Senate and potentially in the House as well, that if nothing else, the current tax regime will be extended. And when you start to bake in all of those things, it brings about the potential of inflation. And if, in fact, we see inflation begin to tick back up and things heat up, does the Fed go back and say, hey, well, wait a minute, let's not do that. Let's take our foot off the gas some and see what we can do to perhaps tamp things down if it appears that it's getting a little bit out of control.
Do you think that they would still be independent enough to make those decisions without influence, given what we've heard campaigned on from President-elect Trump?
That's going to be a very, very interesting dance. And I'll be candid with you. I don't think anyone knows for sure. It's early. The things that we've seen perhaps indicate that, he's a man that's got strong ideas, is fairly confident of himself. I've heard some things floated out there, sort of a shadow kind of person where very early on, he selects who he wants to come in and replaces the Fed chair. So it'll be interesting to see how that goes along. But President-elect Trump has not been shy at all in the past about indicating what he wants. The question simply becomes, how does the current chairman react to those things?
Yeah, worth noting as well that he actually selected the current chair of the Fed Chair Jerome Powell. So, Lee,
absolutely,
always a pleasure getting some of your insights here with us. Lee Baker, founder of Claris Financial Advisors. Appreciate it.
Yep. Thanks for having me again.
Certainly. Coming up, everyone, what a Trump presidency means for businesses on Main Street. And a quick programming note, be sure to save the date for the 2024 Yahoo Finance Invest Conference next Tuesday, November 12th, starting at 8:30 a.m. Eastern. Some of the best and brightest minds across various industries all under one roof. You won't want to miss those conversations.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
In a recent survey from the Small Business and Entrepreneurship Council, 74% of small business owners describe the current environment as good or excellent. As small businesses evaluate growth opportunities over the next 4 years under an incoming Trump administration, inflation, labor quality, and credit markets are three persistent areas entrepreneurs and business owners are prioritizing. Joining me now with more, we've got Karen Kerrigan, who is the Small Business and Entrepreneurship Council CEO and President, here in studio with us. Thanks so much for taking some time.
Great to be here.
So let's talk about this a little bit. As you're thinking about the areas that are being prioritized by small businesses right now, what are they placing at the top of that list and how do they plan to address it?
Well, their biggest concerns for the past couple of years have been inflation, the economy, economic uncertainty, sort of where the economy is going, whether there's going to be a slowdown. And so getting some stability on the policy end, I think, is going to be very, very important for small businesses. They continue to say that tax uncertainty and what's going to happen with the 2017 Tax Cuts and Jobs Act that expires at the end of next year.
Seems like that'll be renewed, though.
The 20%, yeah, it will be now. So I think there's like sort of a collective sigh of relief, if you will, that at least at this point, there will not be any tax taxes raised, and in fact, it could be an extension or making that permanent. So I think that's going to be very, very helpful for small businesses in terms of fueling confidence, because moving forward, they were looking at, they did believe that there would be a recession or some type of downturn next year, so they were taking steps to prepare for that, putting aside capital, cutting spending. So now they're going to be putting that capital, to good use. I think it's going to fuel some confidence and outlook. They sort of getting a handle of where their taxes are and what resources they're going to have for next year. So I think we're going to have a good 2025.
Yeah, and it seems like recession has been avoided for the past 2 years at this juncture. So
well, we never know about black swan events, right? I think that's
indeed.
why, and that's why the last 3 years they've been looking over their shoulders, saying what's coming next.
Right.
I mean, given the experience of COVID, and what happened there.
For labor quality, that was another factor that is really playing into the minds of how small businesses are operating right now, both on the wage front and the quality of employees that they're bringing in too. How do you anticipate that they're going to look across the employment situation more broadly and lay out their plans for hiring and ensuring that they're tapping technology in some instances, but also making sure that there is still the human element and the number of hands on board that they need?
That's been a huge issue, both access to skilled workers, labor, as well as access to capital. And in all of our surveys the last couple of years, many of the businesses said the lack of access to capital or skilled employees was not allowing them to operate at full capacity, right? So they're being squeezed on several ends. So this is a big issue. It's something I think, that the administration, the incoming administration and Congress really has to place a priority on, right? In terms of our educational system, how we're the incentives for people to continue to train. But you're right, in terms of technology, 84% of the small businesses that we surveyed have embraced AI and are using technology. In fact, where they can't find something or skilled labor, they're actually finding a solution, a technology solution to help that. So AI has been a game changer for many businesses in terms of not replacing labor, but complementing labor, but also as a solution where they can't find labor. But and business owners themselves are doing all the training, so they've turned into sort of our national trainers. But it is going to continue to be a big issue. So we got to get this immigration issue under control, and obviously allowing people in the country, more people, because this is going to be an issue for the long term.
And with all this in mind, as we were mentioning some of the pass-throughs to inflation, it's two-pronged. It's where you're sourcing from. It's also the wages that you're paying out, as well as the cost of goods, cost of selling goods as well. All of these things considered, how do you anticipate and how are you hearing small businesses think about the impact of potential additional tariffs right now?
Well, it's concerning, obviously, right? I mean, they're hoping that there is going to be a continued, that inflation will continue to, its course, right? Although they're paying these cumulative elevated costs, over a few years now. But they are concerned about that. I think they're hopeful that, tariffs will be used in a very targeted way, perhaps, but there is concern about that. It's their inputs, right? It's what they pay. So, I think the incoming administration has to balance all of that, right? And say, well, we're providing businesses with capital, we're resolving a lot of these issues in terms of uncertainty. But the tariffs thing could be huge in terms of impacting businesses of all sizes and across the board, and by extension consumers, right? Because they get passed down.
Yeah. What are these businesses and small businesses, especially considering how much they account for of total businesses here in the U.S.? I mean, and a lot of people would probably be shocked to know how much small businesses actually account for the makeup of total businesses here. All of that considered, when they're thinking about their access to capital, making sure that they have the money, the funds needed to continue operating their business, how do they feel? What's the perception right now? And where do they look for improvement in that realm as well?
Well, there's been difficulty, right, in terms of the cost of capital and the availability of capital. So I think a reduction in interest rates, are going to be very helpful, for small businesses, but also on the regulatory side. There's been a lot of pulling back and regs that have been threatening, capital formation, banks, et cetera, capital requirements that have a downstream impact on small business. So I think on the regulatory side, but also if capital becomes more affordable, and certainly more abundant, that's going to be healthy. But it's a perennial issue for a lot of businesses, right? Sure. Access to capital. So the government should be doing all it can to make it easier and not more difficult.
What should President-elect Trump be doing on day one to get the attention and win favor among small businesses?
Well, I think, in terms of the biggest concerns on the economy, I mean, certainly on the tax issue, I think that's important, right? I mean, certainty, solidifying, this is going to happen, and I think we'll have the support of Congress in doing that. On the regulatory end, that's another huge issue. I mean, they faced a lot of threatening regulation, workplace regulation impacting access to capital, maybe looking at what he did in the first administration in terms of 2-for-1, giving small businesses a voice at the table in terms of the regulatory process. That was huge during that time. And over the last 4 years, that has not been followed, that process, those procedures, in terms of making the sausage, if you will. So I think, and bringing people into his administration and giving small business a seat at the table. And a serious SBA administrator who knows, a lot about small business and getting that agency. I think there's a lot of COVID stuff in there that has to be worked out in terms of the EIDL loans and getting that, in order. But I think having someone, an SBA administrator, that's actually a member of the cabinet as well, and just someone who's strong in that regard, I think will send small businesses across this country a pretty big message about how he will prioritize them over the next 4 years.
Yeah, the COVID spending mix and certainly some of the response mechanisms cross administrations still unwinding some of that and then trying to figure out.
And modernizing the SBA in terms of, reaching businesses where they are, right? In terms of their training, using technology more. There's a lot that needs to be done to level up the SBA in terms of really having an impact on training and technical assistance as well.
Karen Kerrigan, who is the Small Business and Entrepreneurship Council CEO and President, joining us here in studio. Thanks so much for the time.
Thank you.
For more on small businesses, you can check out Yahoo Finance's series, Fearless, Exploring the World of Entrepreneurship. And in this week's episode, meet a culinary duo who fought for funding and created a profitable restaurant in record time.
When looking for funds to open Ross, we didn't anticipate having so much difficulty raising capital. We didn't have a proven concept, so no bank was rushing to give us capital. One route that we took was applying for an SBA loan.
The SBA is a guarantor. They actually don't give you the money.
You can scan the QR code that you see there on screen to find Fearless episodes on the Yahoo Finance website, and tune in to Wealth tomorrow, 11:35 a.m. Eastern, to watch the latest episode live. Turning now to the housing market, the national share of mortgage-free homes has continued to climb. The share of mortgage-free homes in the U.S. reached nearly 40% in 2023, per the U.S. Census Bureau's American Community Survey. One-year estimates here. With more on what it means for the housing market, we've got Yahoo Finance's Danny Romero. Hey, Danny.
Brad, more people outright own their home, and the Census Bureau comes out with this data on a yearly basis. They say that the share of mortgage-free homeowners grew about 36% to 40% in the past decade. That is a new high. A lot of these homeowners are in states like West Virginia, Mississippi, where the cost of living is low. It's also really important to know that many of these outright homeowners are baby boomers who refinanced when mortgage rates were lower. That's when, during the pandemic. My parents were actually one of those. But remember, just because you don't have a mortgage payment doesn't mean that you don't have any housing expenses. And so a lot of these baby boomers or these outright homeowners are keeping they're holding on to their bigger homes, which is honestly impacting supply at the end of the day.
Yeah. Well, we also got some new data out this morning from the National Association of Realtors. You've been looking across this. Existing home prices, what's the latest there?
The National Association of Realtors reported this morning that almost 90% of metros across the U.S. had price gains in the third quarter. There were three takeaways from this report. The first one is that the median home price for an existing home grew 3.1% from last year to about $418,000. And the regions that saw the biggest growth in home prices was the Midwest and the Northeast, which isn't really shocking. Those have always been a strong, a strong point in the U.S. The good news is that the monthly mortgage payment fell about 2.4% from last year. And that is because mortgage rates were a lot lower in the third quarter. Now they've reversed and they've gone back up. So this data could change for the fourth quarter. But again, this is, the biggest takeaway here is just really that home prices aren't coming down. Buying a house is still really expensive. And so the affordability issue is still at hand here.
All right, Danny Romero, thanks so much. Appreciate it. And a reminder to our viewers, weekly mortgage rate data from Freddie Mac is due out today, 12 p.m. Eastern Time. We'll break the headline numbers with Yahoo Finance housing reporter Claire Boston. You can head to the Yahoo Finance website for that coverage. Coming up on the other side of this short break, your Yahoo Finance market update with our very own Alexandra Canal. She'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are 2 hours into the trading day, and it's time for Yahoo Finance's market update. Stocks mostly higher after a record-breaking session on Wednesday following the election of Donald Trump. The tech-heavy Nasdaq Composite remains the biggest gainer across the major indexes, up more than 1.2%. And here are 3 things to watch. First up, Bitcoin. The token is still enjoying all-time highs, up nearly 2% as it drifts closer to $76,000 a coin. Other cryptocurrencies like Ethereum have also pushed higher, as a Trump presidency has generally been viewed as a positive outcome for the crypto community. And speaking of Trump, shares of DJT, the company behind his social media app Truth Social, they're reversing the gains they enjoyed on Wednesday. The stock is down by double digits, sinking around 20%. As a reminder, DJT doesn't typically trade on fundamentals and has been categorized as a meme stock by most strategists. Finally, let's round things out with an earnings update from Krispy Kreme. The donut maker seeing shares slide after its earnings and revenue missed Wall Street expectations for the third quarter. The company's outlook has also been dimmed following the sale of its majority ownership stake in Insomnia Cookies. Still, one positive catalyst for the stock will be its upcoming partnership with McDonald's. The company said it's still on track to offer its products daily to nearly 2,000 McDonald's locations by year end. This has been your Yahoo Finance Market Update to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending, scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Brad Smith will return with Wealth, covering all of your personal finance needs after this short break.
Jobless claims for the week of November 2nd came in just below expectations at 221,000 claims. Now, this is 3,000 more claims than the week prior. While data points to a strong labor market, we want to get a sense of how Americans are really feeling about the state of the job market. Our very own Alexandra Canal, she took to the streets of New York City. Here's what she heard.
I think it's a really interesting time. I think there's a lot of opportunity, and I think there's a lot of challenges. There has been disruption to what traditional jobs are. It's both despair and hope.
There's a lot of food jobs out there, fast food, restaurant jobs. It's just about putting yourself out there, stepping out of your comfort zone.
Most places, they don't take you if you have no experience, but how are you going to get experience if they don't hire you, you know what I mean?
I think there's a lot of uncertainty no matter what happens over the course of the next few months.
Bills got to get paid, so there is no. Whether it's shoveling, construction, anything.
The purchasing power is, 80% of what it was 5 years ago? Unless you're getting a 20% raise from that 5 year ago salary, you're in a situation that's less off.
You have to have a bunch of experience to really get a sustainable job or a job that really keeps you and likes you. I'd say just be present with where you are right now and know that everything's going to change. If you can stay as present as you can in your current situation, you will be able to see the shifts that will come or the better opportunities that will come in the future.
Everyone's at capacity and nobody's really looking for more, has the time for more. We're all somewhat at burnout, and trying to find the creative solutions is a lot harder when you're at burnout.
For those who may be feeling burned out at a job that's current, and our next guest here, she's got some tips to help find something new. Joining me now, we've got Eliana Goldstein, who is the founder of Eliana Goldstein Coaching. Great to have you back here in studio. You say that job seekers should be applying to positions even before they're posted online. How exactly does that work?
It's a good question. And I think coming out of the clip that we just saw, there's a lot of mixed sentiments out there, that there's despair, there's frustration, there's burnout, but there's also hope. And as one of them very well said, that it's all about the industry, right? He said construction, manufacturing, and it really depends on where you are applying. So we have to be thoughtful about that and strategic. And because we're in a time right now where there aren't as many jobs getting posted, we need to focus on a proactive strategy as opposed to a reactive strategy. Reactive job searching is waiting for a job to be posted and then applying for it, right? But proactive job searching is focusing on, okay, what are my target companies? Where do I want to work? How do I proactively establish relationships there before anything even gets posted? Because number one, so often jobs don't even get posted in the first place. And at the very least, as soon as it is posted, at least I have the relationship there who can help me out and refer me in. So that is what we really want to be focusing on right now.
And so as we think about the proactive versus the reactive, say you finally get the opportunity to speak with that company, to show your face, to say, hey, I'm valid for this position, regardless of what the prerequisites may look like.
Right.
Once you've finally gotten that in-person FaceTime, whether it be in-person or virtual these days, how do you go about making the best case for yourself?
So I think one of the keys here is that if you have been proactively building these relationships and you've been having conversations with people at the company, in the department, on the teams, you should have already collected a lot of information in terms of what the company's goals are, what some of their challenges are, what some of their problems are. So you are armed with that information so that when you have that first opportunity to make that first impression, you can leverage all of that to your advantage, right? And one of the things I like to say is you need to position yourself as the solution to that employer's problem, right? That is why we hire people. Hiring doesn't happen arbitrarily. It happens because a team, a hiring manager has an issue, has a specific goal in mind, and they want someone to come in and help them with that. So if you're able to kind of lay that groundwork, collect that information proactively, then you can use that when you position yourself and really talk about what your unique value is as a potential employee there.
Right. Immediate value contribution to the team, what many employers are looking to hear. So for those who are trying to figure out as well, even within this market where it feels like they're perhaps running into a wall, one direction or another, trying to get into that new role, what do they need to keep in mind along the process?
I think, and again, they touched on this in this video, I think you have to stay optimistic and hopeful. The one thing that will guarantee you not getting a job is convincing yourself that it's never going to happen, in, that you should just give up and you should stop applying, right? Then you're not going to get anything. So I think it's about remembering that people get hired every single day, and you just have to be more thoughtful and strategic about how you approach it. Sitting there and applying for 100 roles a week and just throwing your resume out places is not going to be helpful for you. But if you can think about, okay, what are my target companies? How do I really add value? How do I go about and really build those relationships, again, proactively, what we've been talking about? It gives you a much better chance. So my message is really be thoughtful, be strategic. Don't just think that, okay, if I send 50 resumes out a week, that gives me the best shot, because that's actually going to lead to more rejection and make you feel more hopeless.
We didn't talk about this ahead of time, but I'm confident in you, and I know you have great answers all the time. How can someone craft a good cold open for themselves and try to introduce themselves in perhaps a non-IRL setting where they know that they're going to have to make a good subject line for themselves, a good first line once somebody opens up their email, and ensure that they get a response?
Such a good question, and it's incredibly counterintuitive, because the best way to get somebody to respond and be willing to sit and have a conversation with you is to not make it about you, it's to make it all about them. I like to say, maybe this is a sad thing to say, that human beings are innately self-interested. We all like to think and talk about ourselves. So if we have somebody saying, hey, I'm great, I did this, I did that, I don't know you from a hole in the wall. Why does that matter to me, right? But if I make it about you, I was so incredibly interested in what you've built in your career, your trajectory. I really feel like you're somebody that I could learn from. I would love to absorb knowledge from you. That piques somebody's interest. So make it about them, make them feel good, compliment them. That will always bring in more responses than just focusing on help me out and being very transactional.
I knew you could handle the curveball. Thank you so much for joining us here this week.
Thank
Eliana
you.
Goldstein, who is the founder of Eliana Goldstein Coaching. She's going to stick around for a hot second here. I do want to play a quick promo and a clip here. If you want to hear more from the Budgetnista, step into the classroom here, and we're going to play a quick clip from the Money Glow Up podcast.
I really believe in multiple offers, and the biggest negotiations that I've helped through coaching, it has been through the biggest gains in compensation I've seen have come when women have had at least one or two external offers that they can leverage. And sometimes you don't even need a hard, cold offer. Just the knowledge that you are interviewing and getting interest from outside employers, that can be enough to get you what you want from your current employer.
And so, Eliana, just as we heard that, lastly, while we have you here with us, negotiating and getting the right salary for yourself and total compensation package right now, where there are many things to consider when you're going and saying, finally, I've got an offer on the table, but I need you guys to maybe do a little bit better here.
Yeah. I mean, she hits the nail on the head that leverage is everything. And obviously, if you can get two offers, that's even better. But I think it still goes back to thinking about negotiation as collaboration. A lot of the times we think about it as me versus you, I need to get this. But if we think about it from the perspective of how can we help each other to achieve a common goal, that I want to, again, add value to your team, I want to help, I know that I can do that. And I know by you valuing me and seeing what I have to offer through, fair and good compensation, that will help us. So I think it's really that approach of how do we collaborate on this to help each other, as opposed to you just need to give me this.
Absolutely. Eliana Goldstein, founder of Eliana Goldstein Coaching. And if you want to hear more from the Budgetnista, you can step into the classroom with the Money Glow Up every Thursday, 12 p.m. Eastern Time. Host Tiffany Alashay creates a space to share real and inspiring money stories, learn financial fundamentals, and build your future. You can watch Money Glow Up on Yahoo Finance or wherever you get them podcasts. Make sure to catch it. Guys, coming up, we're breaking down why you might want to sign up for a health savings account in 2025, and HSA coming up on the other side.
No matter your age or stage in life, experts all agree that it's never too soon to plan ahead for what you need to one day retire. Putting those plans in motion when you're in your 20s, 30s, or even 40s and 50s, and sticking to them can be tough to navigate. Of course, starting sooner than later is better, but how do you know you're on track to retire the way you want?
One of the most important things that you can do when you're in your 30s and 40s is to not neglect what I would describe as the basic building blocks of a sound financial plan.
Yahoo Finance explains where to begin, starting with if you're in your 30s and 40s. Certified financial advisor and Yahoo Finance Decoding Retirement podcast host Bob Powell suggests this general rule. Aim to have 1 times your salary in retirement accounts by age 30 and up to 4 times your salary by age 45. Here's what you can do in your 30s and 40s to save for retirement and stay on track. What are your retirement assets and what are the targets? There's no one-size-fits-all to the amount to save, as that depends on a variety of factors and questions you need to answer.
What is your time horizon to retire? So is it 20 years, 30 years, 40 years? Another is, what is your tolerance for risk? How much market volatility can you tolerate? What is the amount of money that you're trying to set aside to fund your desired standard of living? That will determine how much you need to contribute, as well as what your asset allocation should be as you're saving for retirement.
Assets can include 401ks, Social Security benefits, Roth IRAs, and health savings accounts, among others. For married couples and families, it's recommended that you save enough to replace 70 to 80% of your pre-retirement income in retirement. Be sure to designate a beneficiary, as retirement assets cannot be combined. What can you do in your 30s and 40s to save more as you earn more? Incorporate your retirement assets and income into your overall budget. Focus on earning more if that's a possibility. Have an emergency fund. Maximize your tax benefits, pay off debt, and take advantage of compound interest with your savings and investments.
Create something called an investment policy statement, a blueprint for your investments. The last thing that you want to do is be ruled by emotions and market volatility and start making adjustments to your investment plan or how much you're contributing to your retirement plan based on market conditions.
To create and maintain an investment policy statement, identify your investment objective, the financial goals and timeline you want to hit via your investments. Decide on your risk tolerance, which is typically more aggressive in your 30s and 40s. Identify the types of assets allocated, typically stocks, bonds, or cash equivalents, and stick to that plan. These strategies can keep you on track and offset some of the costs that tend to hit retirement savings harder in your 30s and 40s. Housing typically tops the list, making up 32.9% of expenditures, followed by raising a family and student loan debt. Experts say it's important to be intentional about your financial priorities during these milestone years so that you're not among the 45% of Americans predicted to run out of money during retirement, according to Morningstar. And now you know how.
Health insurance open enrollment is underway, and if you're signing up for a health plan on the exchange at healthcare.gov, or if your employer notified you about their insurance plans, you may be considering a health savings account, known as an HSA. Here to break down what you need to know about HSAs and some changes coming to them in 2025 is Yahoo Finance's Carrie Hannon. Carrie, good to see you. Let's start with the basics. What exactly is an HSA?
Hey, Brad, great to be here. A health savings account is an account your employer offers to you that you can put money aside for medical expenses, qualified medical expenses, that it's not like your flexible savings account where you have to use it that year. No, these are incredibly great, powerful accounts that you can roll over year to year, the money you put in there. You can take it with you when you change employers. I mean, I think health savings accounts are one of the smartest ways to stoke up your retirement savings because you don't even have to start taking them out at any mandatory time. And we know medical expenses are one of the highest costs for people in retirement. So it's terrific. And one more thing that is the most important part about the health savings account, Brad, it's the triple tax advantage. You put money into these accounts pre-tax. The money grows in these accounts without paying tax on that, and you can take it out without paying taxes on it. That's a triple tax. No other account offers this to you. And the important thing is it has to be taken out for qualified medical expenses. If it's not, and you're under age 65, you're going to pay a 20% penalty. So that's the one caveat you have to know. But they're really, really important for people to realize it's kind of a neat way to save for retirement as well as your medical expenses.
So how do you know and evaluate if an HSA is right for you?
Oh, yeah, good point. Now, not everyone can have one of these. You need to be in a high deductible medical plan. So what that means is that your annual deductible is not less than $1,650 a year for an individual and $3,300 for a family plan. So you have to be enrolled in one of these plans where it's lower premiums but higher annual deductibles.
And so how can the HSA be put to use?
Yeah, I mean, you can really use it for a variety of medical costs over time. And as I said, I love it if people cannot use them as sort of an annual checking account, but actually to use these for retirement savings for medical costs and retirement. But you can use them for everything from paying for your deductibles, for vision, for any really medical expense you have that's out of pocket. So it's super handy and it's a great way to cover those costs.
I got to hustle to my finish here, but what are the changes coming in 2025?
Yeah, they're bumping up. The IRS has bumped up how much you can set aside in these accounts. It's not a huge amount of money. This year, it's going to be $4,300 for the individual, $8,550 for family coverage, and so that's really good to know. And it's important for people to know it's something to pay attention to. And your employer automatically takes this out of your paycheck. It is not something. But the point that it can roll over year to year and it continues to grow, and the triple tax, I just love it.
Yahoo Finance's own Carrie Hannon. Carrie, thanks so much for breaking down the HSAs. Appreciate it. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern Time.